Good morning, everyone, and welcome to today's presentation. I'm pleased to introduce the topic, Basics of Accounting. My name is Dr. M. Sirajuddin. I'm a research supervisor and assistant professor at the PG and Research Department of Commerce, Jamal Mohammed College in Tiruchirappalli. In this session, we will explore fundamental accounting concepts, principles, and practices. I look forward to guiding you through this important subject. Let's get started. Welcome to the Basics of Accounting. First, let's understand what bookkeeping really is. It's simply the process of recording all business transactions in the company's books. Now, financial accounting takes this a step further. It's a fundamental part of the larger accounting field, providing a structured and systematic way to record, summarize, and report financial data. Financial accounting is built on a foundation of principles, conventions, and standards. These create a consistent framework, ensuring that the financial reports we prepare are understandable, reliable, and comparable across different periods and organizations. These reports are crucial because both internal managers and external stakeholders, like investors, regulators, and creditors, depend on accurate financial information to make informed decisions. At the heart of financial accounting are financial statements. These include the balance sheet, which shows the company's financial position at a specific point in time, the profit and loss account, or income statement, which details performance over a period, and the cash flow statement, which reveals how cash moves in and out of the business. Preparing these statements follows established accounting principles, such as GAAP or IFRS, depending on the country or regulatory environment. Now, let's talk about the nature and scope of financial accounting. It's primarily historical and objective, meaning it records actual past transactions based on verified documents. Unlike management accounting, which looks ahead to planning and decision-making, financial accounting focuses on past events, giving us a snapshot of the company's financial health at a particular moment. The scope of financial accounting is quite broad. It involves recording daily transactions in journals, posting these to ledgers, preparing trial balances, and ultimately drafting the financial statements. The main goal here is to provide quantitative financial information that helps assess a business's stability, profitability, and operational efficiency. So, in essence, financial accounting gives us a reliable, consistent way to understand and communicate a company's financial story, supporting both internal management and external stakeholders in making sound decisions. Let's start with the basics of financial accounting. Financial accounting is a specialized branch of accounting focused on recording, summarizing, and reporting a company's financial transactions. These are done through standardized formats over specific accounting periods. Think of it as the backbone of the entire accounting system in every business. It keeps accurate and systematic records of all financial activities. The main goal here is to provide useful financial information for making economic decisions. This includes details about a company's financial position, how well it performs, and its cash flows. These details are compiled into financial statements like the balance sheet, profit and loss account, cash flow statement, and the statement of changes in equity. These statements are then used by a wide range of stakeholders, both inside and outside the organization, to make informed decisions. It's important to note that financial accounting is historical. It deals with past transactions, giving us a picture of what has already happened. To ensure clarity and consistency, it follows established principles and guidelines such as GAAP or IFRS. These rules help make sure that financial statements are transparent, comparable across different organizations, and reliable over time. Now, various experts have defined financial accounting in slightly different ways. For example, the American Institute of Certified Public Accountants describes it as the art of recording, classifying, and summarizing transactions in a meaningful way, and interpreting the results. The IASB emphasizes that it's about preparing financial statements that reflect a company's financial performance and position according to recognized standards. And Kohler's dictionary highlights that it records financial transactions and periodically prepares statements to show how the business is operating and its financial standing. In essence, financial accounting is all about systematically capturing financial data, preparing clear reports, and helping users understand the financial story of a business. Let's start with the basics of accounting. R.N. Anthony defines it as a system of recording, summarizing, and interpreting business transactions. Essentially, financial accounting is a structured process focused on accurately documenting financial data and then analyzing it through financial reports. This helps us understand how a business is performing financially. Now, the main objectives of financial accounting are quite important. First, there's recording financial transactions. This means systematically documenting every monetary event, like sales, purchases, receipts, payments, salaries, or depreciation. We use the double entry system to ensure that all these activities are properly recorded for future reference and verification. It's the foundation of reliable financial data. Next, we need to determine whether the business has made a profit or a loss during a specific period. At the end of an accounting period, we prepare the income statement, or profit and loss account. This statement compares revenues earned against expenses incurred, giving us a clear picture of the business's financial performance. It's crucial for management and owners to understand how well the business is doing financially. Another key goal is to ascertain the financial position of the business at a given point in time. This is done through the balance sheet, which shows the company's assets, liabilities, and owner's equity. It provides a snapshot of what the business owns and owes, helping stakeholders assess its financial stability and liquidity. Finally, financial accounting serves to provide reliable financial information to stakeholders, such as investors, creditors, government authorities, managers, and the public. Investors, for example, rely on this data to decide whether to invest. Creditors use it to evaluate creditworthiness, and regulators ensure compliance. So, in essence, financial accounting enables transparent communication between the business and its stakeholders, supporting informed decision-making. Let's take a closer look at the basics of accounting and why they're so important for a business. First, ensuring legal compliance is a key aspect. Most countries require businesses to prepare their financial accounts according to specific laws and standards. This helps make sure that companies are following tax laws, corporate regulations, and their financial reporting obligations. It also means that the reports they prepare can be submitted smoothly to government departments and auditors, keeping everything transparent and above board. Next, financial accounting plays a crucial role in facilitating decision-making. While it's primarily used by external parties, it's also incredibly valuable for internal management. The financial data reveals important trends, highlights where costs are high, and points out areas that might be inefficient. This information supports managers in budgeting, assessing performance, allocating resources, and planning for the long term. Another vital function is maintaining control over assets. Financial accounting helps keep a systematic record of a company's assets and liabilities. This ensures assets are used appropriately and protected against loss, theft, or misuse. Tasks like depreciation, revaluation, and periodic audits of fixed assets are all part of this process, helping to safeguard the company's resources. Financial accounting also supports auditing and verification processes. Auditors depend on accurate records to perform both internal and external audits. When the accounting system is well maintained, it becomes easier to verify financial data, which promotes accountability and transparency in all financial dealings. Moreover, it's essential for tax assessment. Financial accounting simplifies the preparation of tax returns and ensures compliance with tax laws. It helps calculate liabilities accurately on profits, sales, and income. Plus, it supports the timely submission of reports to tax authorities, reducing the risk of penalties. Finally, financial accounting acts as the historical record of a business. It provides a chronological, permanent trail of every financial transaction. This record allows us to trace past events and analyze the company's financial performance over different periods, giving us valuable insights into its financial history. Let's take a closer look at the basics of accounting. The objectives of financial accounting go well beyond just recording transactions. It helps us determine whether a business is making a profit or a loss, and it reveals the overall financial position of the company. But it doesn't stop there. It also plays a crucial role in fulfilling legal obligations and providing valuable information for managers to make informed decisions. As our economy becomes more global and complex, the importance of financial accounting continues to grow. It serves as a key tool for ensuring transparency, building trust, and supporting sound decision-making both in the private sector and in government. Now, the information generated through financial accounting isn't just for one group of people. It serves a variety of stakeholders. For example, investors and shareholders use these reports to assess whether their investments are viable and profitable. Creditors and lenders, like banks, review financial statements to determine the creditworthiness of a business. Management, although mainly involved with management accounting, also relies on financial statements for strategic planning and control. Government agencies, such as tax authorities and financial regulators, depend on this data for auditing and compliance purposes. And finally, the public, researchers, and analysts study financial reports to evaluate trends or make broader assessments. So, why is financial accounting so important? First, it promotes transparency by providing a clear picture of a company's financial activities, which helps build trust among stakeholders. Second, reliable financial information supports better decision-making, whether it's managerial choices, investment strategies, or policy development. Third, it ensures accountability, holding management responsible for the company's financial performance. And lastly, because financial information is standardized, it allows us to compare companies across different industries and over time, making it easier to analyze and understand the broader financial landscape. Let's start with the basics of accounting, which are essential for any business. In most places, it's a legal requirement to prepare and keep financial accounts. This helps ensure transparency and compliance with regulations. However, while financial accounting is absolutely necessary, it does have some limitations. For example, it is primarily based on past data, so it reflects what has already happened rather than predicting the future. This means it may not always be useful for making forward-looking decisions. Another important point is that financial accounting only records monetary items, which means it ignores qualitative factors like employee satisfaction or customer loyalty, elements that can be just as vital to a business's success. Subjectivity also plays a role in accounting because, despite established standards, estimations such as depreciation, provisions, and reserves involve judgment calls. This can introduce some variability in financial reports. Additionally, traditional accounting methods often ignore inflation, so during times of rising prices, they may not accurately reflect the true value of assets. Financial accounting also tends to follow a rigid format, which can limit its ability to address specific informational needs of managers who might require more tailored reports. Now, let's look at how financial accounting has evolved over time. Its roots trace back to Luca Pacioli's De Bollentri bookkeeping system introduced in the 15th century. Since then, it has become more complex, driven by expanding business environments, globalization, and technological advances. In the 20th and 21st centuries, we saw the development of standard-setting bodies like the IASB and FASB. They created frameworks such as IFRS and GAAP, which aim to harmonize accounting practices across countries and industries, making financial reports more comparable and reliable. More recently, digital systems and automation have transformed financial recording and reporting. Cloud platforms, artificial intelligence, and real-time dashboards have significantly improved the accuracy, speed, and accessibility of financial information, shaping the future of accounting. Let's take a closer look at how financial accounting connects with other branches of accounting. Financial accounting doesn't operate in a vacuum. It's closely linked to several other areas. For instance, cost accounting focuses on recording, analyzing, and controlling costs, which helps with internal decision-making. Management accounting, on the other hand, emphasizes forecasting, budgeting, and evaluating performance to support strategic planning. Then there's auditing, which examines the accuracy and fairness of financial records and statements prepared through financial accounting. Lastly, tax accounting involves adapting financial data to comply with tax laws and calculating tax liabilities. These connections are vital because they create a comprehensive framework that addresses the diverse needs of a business. In summary, financial accounting is fundamental. It provides the standardized methods for recording transactions and communicating financial results. It underpins the integrity and transparency of financial systems within organizations. Despite some limitations, its importance can't be overstated. It forms the foundation for financial decision-making, regulatory compliance, and building investor confidence. As businesses grow and globalization advances, the principles of financial accounting will continue to be crucial. They support economic growth, promote efficiency, and foster sustainable development. Sure, let's go through some fundamental questions on the basics of accounting to deepen our understanding. First, what exactly is financial accounting? Well, it's the process of recording, summarizing, and reporting the financial transactions of a business. Now, can anyone think of two key features of financial accounting? Typically, it's characterized by its focus on accuracy and its use of standardized reporting formats. Moving on, what are the main objectives of financial accounting? Essentially, to provide relevant financial information to help users make informed decisions. Now, let's define accounting in simple terms. It's the art of recording and analyzing financial information. Who are the primary users of this financial information? They include investors, creditors, management, and regulators, all of whom rely on financial reports to assess the company's health. Speaking of benefits, what are two advantages of financial accounting? It promotes transparency and helps in compliance with legal requirements. What do we mean by financial statements? These are the formal reports, like the balance sheet and income statement, that summarize the financial position and performance of a business. But of course, financial accounting has its limitations, such as not capturing real-time data and sometimes being influenced by accounting policies. It's also useful to differentiate between financial and cost accounting. Financial accounting focuses on the overall financial position, while cost accounting deals with the costs of production and operations. Both are vital but serve different purposes. Lastly, what are some characteristics of good accounting information? Clarity, relevance, accuracy, timeliness, and comparability are all crucial traits that ensure the information is useful for decision-making. Now, moving on to the broader scope, financial accounting not only involves recording transactions, but also preparing financial statements that reflect the true financial position of the business. Its main objectives are to provide useful financial data to stakeholders, ensure accountability, and aid in planning and decision-making. Maintaining proper financial accounts offers advantages like better financial control and increased credibility. When we compare financial accounting to management accounting, the key difference is that financial accounting is primarily for external users, while management accounting is for internal decision-makers. The users of financial accounting include investors, creditors, government agencies, and other stakeholders, all of whom depend on this information for various decisions. Let's also highlight some features. Financial accounting is based on historical data, it adheres to accounting standards, and it emphasizes reliability and comparability. However, it does have limitations, such as not providing real-time data and sometimes being less flexible. Defining financial accounting involves understanding its components like recording, classifying, and summarizing financial transactions. The role of financial statements in accounting is crucial. They communicate the financial health of the business clearly to all stakeholders. Finally, why is accounting so important in business? Because it provides the necessary information to make strategic decisions, ensures compliance with laws, and helps in monitoring the financial performance over time. So, understanding these basics is fundamental as we move forward in mastering the art of accounting. Let's dive into the basics of accounting, focusing on Part C, 10-mark questions. First, what exactly is financial accounting? Well, it's the process of recording, summarizing, and reporting the financial transactions of a business. Its main features include providing a clear, accurate picture of a company's financial health, following standardized rules, and being primarily focused on external reporting. The objectives are to help external stakeholders like investors, creditors, and regulators make informed decisions. Now, moving on to the advantages of financial accounting. It's essential for transparency, legal compliance, and facilitating decision-making. But it also has limitations, such as reliance on historical data, which may not always predict future performance, and sometimes complexity that can make understanding financial statements a challenge for non-experts. Understanding the objectives of financial accounting is crucial because they include providing relevant financial information, ensuring accuracy, and supporting accountability. This information helps stakeholders, whether they're investors assessing risk or managers making strategic decisions, by giving them a reliable foundation. Financial accounting also has a broad scope, covering the entire financial activities of a business, and its functions include preparing financial statements, maintaining books of accounts, and ensuring compliance with regulatory standards. You might have heard the phrase, "Financial accounting is the language of business." Think of it as a universal way of communicating a company's financial story, allowing anyone, be it a banker, investor, or regulatory body, to understand the company's financial position clearly. When we compare financial accounting with cost and management accounting, the key difference is that financial accounting focuses on providing an overall picture for external users, while cost and management accounting are more detailed, internal-focused tools aimed at helping managers make decisions. The role and importance of accounting in modern businesses cannot be overstated. It helps in strategic planning, monitoring performance, and ensuring legal compliance, all of which are vital in today's competitive environment. Financial accounting information is useful for both internal users, like managers who need detailed data to run the business, and external users, such as investors or government agencies, who rely on these reports to make their decisions. Finally, preparing financial statements involves several steps: collecting data, recording transactions, adjusting accounts, and then compiling the balance sheet, income statement, and cash flow statement. These statements are vital for assessing the company's performance and financial position. In today's fast-changing economic environment, financial accounting is more important than ever. It provides the transparency and accountability needed to build trust with stakeholders and adapt to market changes efficiently. Let's start by understanding the basics of accounting. Accounting is often called the language of business because it helps stakeholders, like owners, investors, and managers, understand how a business is performing financially. To keep the information consistent, reliable, and comparable across different businesses, accounting follows a set of guiding principles known as concepts or assumptions. These concepts form the foundation for all accounting activities, from recording transactions to preparing financial statements. They ensure that financial reports are prepared systematically, uniformly, and logically, making it easier for everyone to understand and trust the financial information. These basic concepts are universally accepted and practiced by accountants around the world. They are embedded within important frameworks like Generally Accepted Accounting Principles, or GAAP, and International Financial Reporting Standards, or IFRS. By adhering to these principles, businesses ensure their accounting practices are consistent, no matter the industry or location. Now, let's look at the business entity concept. This concept treats a business as a separate entity from its owners. That means the personal financial matters of the owner or shareholders are not mixed with the business's financial activities. For example, if the owner invests rupee 1,000,000 into the business, we record that as a liability or capital of the business, not as the owner's personal money. This separation helps maintain clarity and accuracy in financial records and is crucial for legal and financial reporting. Next is the money measurement concept. This principle states that only transactions and events that can be measured in terms of money are recorded in the books. Things like employee morale, brand reputation, or customer loyalty, although important, are not recorded because they can't be quantified easily. For instance, if a skilled employee resigns, that's not recorded in accounting, even though it might impact productivity. This concept helps ensure that accounting remains objective and consistent, but it also means some valuable non-monetary aspects of a business are not captured in financial statements. Together, these concepts help create a clear, standardized approach to accounting, making it easier to analyze and compare financial information across different businesses and industries. Let's now discuss some fundamental concepts of accounting that form the backbone of financial reporting. First, we have the going concern concept. This idea assumes that a business will continue to operate indefinitely unless there is clear evidence to the contrary. What this means is that businesses can defer recognizing certain expenses, like prepaid expenses or depreciation, over future periods. For example, if a company purchases machinery worth 10 lakh rupees, it doesn't expense the entire amount in the year of purchase. Instead, it depreciates the machinery over several years. This concept is crucial because it influences how we value assets and make long-term investment decisions. Next, we have the accounting period concept. This concept divides the life of a business into specific time intervals, usually a financial year from April 1 to March 31 in India. The purpose of this is to prepare financial statements that allow us to compare performance across different periods. For instance, the profit and loss account is prepared annually to show how the business performed during that year. This helps businesses and stakeholders analyze trends, set future targets, and make informed, timely decisions. Finally, let's look at the cost concept, also known as the historical cost concept. According to this principle, assets are recorded at their original purchase price, not at their current market value. So, if a building was bought for 50 lakh rupees, it will stay recorded at 50 lakh, even if its market value increases to 1 crore. While this approach provides objectivity and makes verification easier, it may not always reflect the true current value of the assets. And last, but very important, is the dual aspect concept. This is the core principle behind double entry accounting. It states that every transaction impacts at least two accounts, creating a debit and a credit. This is expressed through the fundamental accounting equation: assets equal liabilities plus capital. This dual aspect ensures that the accounting records stay balanced, providing a clear and accurate picture of the business's financial position. Connecting all these concepts helps us understand the foundation of sound accounting practices, guiding us in accurate financial reporting and decision-making. Let's look at some fundamental accounting concepts that help us maintain accurate records. For example, if a business takes a loan of rupee 5,000,000, the cash asset increases, and simultaneously, the liabilities, specifically the loan payable, also increase by the same amount. This simple example highlights the core idea that every financial transaction affects at least two accounts, ensuring the books stay balanced. This concept forms the basis of the balance sheet and helps us verify the accuracy of our accounts. Next, we have the realization concept, or revenue recognition concept. This principle states that revenue should only be recognized when it is actually earned, not necessarily when cash is received. For instance, if goods are sold on credit in March, we record the revenue in March, even if the customer pays in May. This approach prevents us from overstating or understating our income for a particular period, giving a clearer picture of our financial health. Moving on to the matching concept, which is crucial for accurate profit calculation. It says that expenses should be matched with the revenues they generate within the same period. So, if you make a sale in March, related expenses like commissions or delivery charges should also be recorded in March. This ensures that our profit and loss account reflects a true and fair view of profitability for that period. Then, we have the accrual concept. This principle emphasizes that income and expenses should be recognized when they are earned or incurred, regardless of cash flow. For example, if you pay a salary in April for work done in March, you record that salary expense in March. This makes our financial statements more reliable and complete, showing all obligations and rights accurately. Finally, there's the concept of consistency. It requires us to apply the same accounting policies and methods, such as depreciation or valuation techniques, across different periods. This consistency allows us to compare financial data over time meaningfully and ensures our records are comparable and trustworthy. Overall, these concepts form the backbone of sound accounting practice, helping us produce accurate, reliable, and comparable financial information. Let's talk about the basics of accounting with some key principles that guide how we record and report financial information. For example, if a business uses the straight-line method of depreciation in one year, it shouldn't switch to the diminishing balance method the next year without a good reason. Any such change needs to be clearly disclosed and justified in the notes to the accounts. Now, one important concept is the conservatism or prudence concept. It encourages us to be cautious, recognize potential losses as soon as we anticipate them, but only recognize gains when they are actually realized. For instance, we make provisions for doubtful debts, but don't record expected gains until they are confirmed. This approach helps prevent overstating income and assets. Next is the materiality concept. This means that only information significant enough to influence decisions should be included in financial statements. Trivial details, like small expenses such as pencil purchases, can be treated as indirect expenses or ignored to keep reports relevant and uncluttered. Then there's the objectivity concept. It emphasizes that all accounting records should be based on verifiable evidence, like invoices, bills, receipts, or contracts. For example, an asset should only be recorded after we have a valid purchase invoice. This builds trust and credibility in our financial reports. Finally, understanding these basic concepts is essential because they form the foundation for consistent, reliable, and comparable financial information. They guide us in preparing accurate, standardized reports that stakeholders can understand and rely on. Concepts like going concern, consistency, and prudence ensure our financial statements reflect a true and fair view of the business. Let's talk about the basics of accounting. By applying principles like accrual and matching, businesses can present a more accurate picture of their financial position. These concepts are crucial because they help in making informed decisions, promote transparency, and build trust with investors, regulators, and other users of financial statements. Ultimately, they support better financial management and ensure compliance. However, it's important to recognize that these basic concepts have their limitations. Many rely on assumptions, such as the going concern assumption or historical cost, which might not always reflect real-world scenarios, especially during times of economic instability. For example, the money measurement concept excludes qualitative factors like employee morale or brand value, which are also vital to understanding a company's true health. Additionally, concepts like materiality and conservatism can be quite subjective, leading to inconsistencies. And, as business models and technologies evolve rapidly, these traditional concepts often lag behind, affecting the relevance and accuracy of financial reports in a fast-changing environment. Now, to sum it up, these basic accounting concepts are the foundation of the entire discipline. They ensure that financial statements are consistent, reliable, and meaningful across different organizations. They provide a structured framework for recording and reporting financial data, which enhances transparency and makes it easier to compare results. This framework also supports sound decision-making, whether it's recognizing revenue correctly, matching expenses to the right periods, or making sure records are complete and unbiased. As businesses grow and change, these concepts are continually refined, but their core role remains unchanged. They shape how accountants operate and how stakeholders interpret financial information. So, understanding these fundamentals is key to grasping the broader picture of financial accounting and how it helps stakeholders make informed decisions in a dynamic business world. Let's begin by understanding some fundamental concepts of accounting, starting with the basics. The first question is, what is the business entity concept? Essentially, it tells us that the business is considered a separate entity from its owners. This helps us keep personal and business finances distinct, which is crucial for accurate financial reporting. Next, we have the money measurement concept. This means that only those transactions that can be measured in monetary terms are recorded in the books. For example, things like cash, inventory, or receivables are included, but not employee skills or customer goodwill. Moving on, the going concern concept assumes that the business will continue to operate indefinitely, unless there's evidence to the contrary. This assumption affects how we value assets and liabilities, as we don't expect to sell everything immediately. The dual aspect concept is the foundation of double entry bookkeeping. It states that every transaction affects at least two accounts, meaning, for every debit, there must be an equal credit. This keeps the accounting equation balanced: assets equal liabilities plus equity. Then there's the accounting period concept, which divides the life of the business into specific periods, like months, quarters, or years, to prepare financial statements. This helps stakeholders assess performance over time. The cost concept tells us that assets are recorded at their original purchase price, not their current market value. This provides objectivity and reliability in our financial records. The matching concept is about aligning expenses with the revenues they help generate within the same period. This way, we can accurately determine profit, reflecting the true financial performance. Next is the conservatism concept, which advises us to choose the least optimistic estimate when faced with uncertainty, ensuring that profits are not overstated and risks are properly accounted for. The realization concept focuses on when revenue should be recognized. Typically, revenue is realized when the goods are delivered or services are performed, and there is reasonable certainty of receiving payment. Finally, some basic accounting concepts include the business entity and cost concepts, which we've discussed, among others like the going concern and matching concepts. These principles guide us in maintaining accurate, consistent, and reliable financial records. Now, moving to Part B, where we look at more detailed questions. For example, explaining 5 basic accounting concepts with examples helps us understand how these principles work in practice. Distinguishing between the going concern and money measurement concepts clarifies their different roles. One relates to the assumption of business continuity, the other to the measurement basis. We also explore how the accrual concept and matching concept work together to give a true picture of profitability, even if cash hasn't yet been received or paid. The dual aspect concept underpins double entry bookkeeping, ensuring every transaction keeps our books balanced. Understanding the importance of the business entity and cost concepts helps us see why clear boundaries and valuation methods matter. Similarly, the accounting period concept is vital for preparing timely financial statements, allowing stakeholders to make informed decisions. The conservatism concept influences how we handle uncertainties, often leading us to be cautious in reporting profits. The realization principle determines when revenue is recognized, affecting the timing of income reporting. The matching concept ensures expenses are properly aligned with revenues, providing a more accurate profit figure. Lastly, differentiating between cash basis and accrual basis, accounting highlights how revenues and expenses are recognized either when cash is received or paid, versus when they are earned or incurred, which impacts the financial statement's accuracy and usefulness. Now, let's explore some fundamental concepts that form the backbone of accounting. When we talk about accounting concepts, we're referring to the basic principles and assumptions that guide the recording and reporting of financial information. They ensure consistency, reliability, and comparability across financial statements. I'll start with 6 major accounting concepts, explaining each with examples. The going concern concept assumes that a business will continue to operate indefinitely, unless there is evidence to the contrary. For example, a manufacturing company plans to keep producing and selling goods for many years. Next is the dual aspect concept, which states that every transaction affects at least 2 accounts, maintaining the accounting equation: assets equal liabilities plus equity. If a business takes a loan, its cash increases while liabilities also go up. The matching concept emphasizes that expenses should be recognized in the same period as the revenues they help generate. For instance, the cost of goods sold is matched with the revenue from sales in the same period. The cost concept insists that assets should be recorded at their original purchase price, not their current market value. So, if a building was bought for $500,000, that amount remains on the books even if its market value changes later. The money measurement concept requires that only transactions measurable in monetary terms are recorded. For example, employee skills or customer satisfaction are important, but are not recorded because they can't be quantified in money. And finally, the accounting period concept divides the life of a business into fixed periods like months or years, allowing timely financial reporting. This helps stakeholders assess performance regularly. Now, moving to the significance of some key concepts: the going concern, dual aspect, and matching concepts. These are crucial because they influence how financial statements are prepared and understood. The going concern assumption allows us to record assets at their cost, expecting the business to continue. Without it, we might have to value assets at liquidation prices, which would distort the financial picture. The dual aspect ensures every transaction balances out, making our accounts accurate and complete. The matching concept helps us recognize revenues and expenses in the correct period, giving a true reflection of profitability. These basic accounting concepts are vital for maintaining consistency and accuracy. They provide a standardized framework so that financial reports are comparable over time and across different entities, enhancing trustworthiness. Let's also briefly discuss the accrual and matching concepts with examples. The accrual concept states that revenues and expenses should be recognized when they occur, not necessarily when cash is received or paid. For example, if a service is provided in December but payment is received in January, we record the revenue in December. The matching concept, as I mentioned earlier, aligns expenses with related revenues. So, if you pay salaries at the end of the month for work done during that month, both are recorded in the same period. Now, regarding the business entity and cost concepts, these principles influence how we prepare accounts. The business entity concept treats the business as separate from its owners. So, personal expenses of owners are not recorded in the business accounts. The cost concept, as discussed, records assets at their purchase price, providing a reliable basis for valuation. Moving on to the principles behind the realization and conservatism concepts. Realization asserts that revenue should be recognized when goods are delivered or services are performed, not when payment is received. For example, sales are recorded when the product is shipped, even if payment is pending. The conservatism concept advises caution. Expenses and liabilities should be recognized as soon as they are probable, but revenues only when they are certain. This prevents overstating assets or income, maintaining prudence in reporting. When we compare all these major concepts, we see they collectively ensure that financial statements are accurate, consistent, and meaningful. They underpin the integrity of financial reporting and help stakeholders make informed decisions. Remember, as the famous saying goes, accounting concepts form the foundation of financial statements. Without them, financial information could be misleading or unreliable. For example, ignoring the cost concept might lead to overstated assets, giving a false sense of financial strength. If we ignore these principles, it can lead to misinterpretation of results, like overstating profits or understating liabilities, ultimately misleading users of financial statements. Lastly, let's touch on the relevance of the money measurement and accounting period concepts. The money measurement concept ensures that only quantifiable transactions are recorded, providing clarity and precision. Meanwhile, the accounting period concept allows us to divide the business's life into specific periods, facilitating timely analysis and decision-making. Both are essential for consistent, meaningful financial reporting. They help maintain order, comparability, and accuracy, which are fundamental to sound financial management and reporting. Let's talk about the basics of accounting, specifically the conventions that guide our practices. Now, while accounting concepts are the fundamental principles, conventions are the practical practices that have developed over time. These conventions help ensure our financial statements are consistent, reliable, and comparable. They are not laws, but they are considered good practice among accountants. One of the key conventions is the convention of consistency. This basically means that once we choose an accounting method, we should stick with it across periods unless there's a strong reason to change. For example, if we decide to use the straight-line method for depreciation this year, we should continue using it next year too. The same applies to inventory valuation methods like FIFO or weighted average. Why is this important? Well, it allows users of financial statements to compare results over different periods meaningfully. It helps in spotting trends and understanding how the business is performing over time. Plus, it prevents manipulation. If we kept changing methods frequently, it could distort the real financial picture. So, in essence, the convention of consistency plays a crucial role in making sure our financial reports are trustworthy and comparable across different periods. Now, let's look at some important exceptions in accounting. If a company needs to change its accounting policy or method to better reflect its financial situation or to meet regulatory requirements, that change must be disclosed. Importantly, the impact of this change on financial results should also be clearly communicated. Moving on to the convention of full disclosure, this is all about transparency. The idea is that all significant and relevant financial information should be fully disclosed either in the financial statements themselves or in the notes that accompany them. This ensures that everyone, whether it's investors, creditors, or regulators, has a complete understanding of the company's financial position and performance. Disclosures can take various forms, such as footnotes, annexures, or schedules. They might include details about the accounting policies used, contingent liabilities, pending lawsuits or disputes, changes in capital structure, or related party transactions. Why is this important? Well, full disclosure helps build trust, promotes transparency, and supports informed decision-making by external users. It also prevents misunderstandings or misinterpretations of the financial data. For example, if a company has mortgaged its fixed assets to secure a loan, that fact should be disclosed. Similarly, if there's a pending lawsuit, it should be mentioned as a contingent liability to give a clear picture. Finally, let's touch on the convention of conservatism, also known as the principle of prudence. This principle suggests that potential losses should be recognized as soon as they are foreseeable, even if they haven't been finalized yet. It encourages a cautious approach to financial reporting to avoid overstating assets or income, and to ensure that risks are adequately reflected in the financial statements. Let's take a closer look at the basics of accounting regarding gains. It's important to remember that gains should not be recorded until they are actually realized. This approach helps ensure that our financial statements don't give an overly optimistic picture of the company's financial health. The key rule here is, anticipate no profits, but provide for all possible losses. In practice, this means creating provisions for doubtful debts. So, if there's a chance a debtor might default, we set aside some amount as a precaution, even if the default hasn't happened yet. Similarly, if inventory becomes obsolete or moves slowly in the market, we write it off to avoid overstating assets. And even if the market value of assets like equipment or property increases, we don't record that gain until it's realized through a sale or other transaction. This cautious approach is vital because it prevents us from overstating income and assets, which can mislead stakeholders. It also promotes responsible financial reporting and builds credibility with external parties such as investors and creditors. Now, let's talk about the importance of this approach. By recognizing only actual or probable losses, we keep our financial statements accurate and reliable. For example, when we create a provision for doubtful debts, we're preparing for possible future losses, not assuming payments have been missed. Similarly, if stock prices fall, we record the loss, but if they rise, we wait until the increase is realized before recording it. Moving on to the convention of materiality. This concept tells us that only transactions or events that are significant enough to influence decision-making should be recorded and disclosed. So, if an item is minor or trivial, we can group it together or ignore it to keep the financial statements clear and simple. What counts as material depends on the size and nature of the business. The main goal here is to avoid cluttering financial reports with unnecessary details, so decision makers can focus on the items that truly matter. This promotes efficiency and cost-effectiveness in our accounting process, ensuring we spend our resources on what's most impactful. In summary, these principles, realizing gains only when they happen and emphasizing materiality, help us produce honest, clear, and useful financial statements that support sound decision-making. Now, let's look at some other common accounting conventions that are followed in practice. Although the four main conventions we've discussed earlier are the most recognized, there are additional ones that help ensure consistency and reliability in financial reporting. One such convention is the convention of objectivity. This means that all accounting entries should be backed by verifiable evidence, like invoices, bills, bank statements, or contracts. The goal here is to minimize subjectivity and bias, making sure that the financial statements are based on factual, tangible evidence. This enhances the accuracy and reliability of our records and builds trust among users. It also provides an audit trail, which is essential for verification purposes. Another important convention is the convention of timeliness. This stresses that financial information must be reported within a reasonable period. If reporting is delayed, the information can become outdated or irrelevant, which defeats its purpose. Timely reporting ensures that stakeholders have current data to make informed decisions. Now, why are these conventions so important? Well, they contribute significantly to the overall quality and usefulness of financial statements. They promote uniformity, meaning different organizations follow similar practices, making comparisons easier. They also ensure transparency through full disclosure and conservative accounting practices, giving a clear view of the business's financial health. And finally, they enhance reliability, so users can trust the information for making accurate and informed decisions. In essence, these conventions form the backbone of trustworthy financial reporting, helping us present a true and fair view of the business. Let's take a closer look at the basics of accounting, starting with consistency. When businesses stick to the same principles year after year, it makes it much easier to analyze trends and evaluate performance over time. Consistency provides a stable framework that helps us compare financial data meaningfully. Next, trust building is crucial. Proper conventions and practices help establish trust among investors, creditors, and the public. When everyone understands and expects certain standards, confidence in the financial information increases. Now, while accounting conventions are essential, they do have limitations. For example, subjectivity can come into play. Concepts like materiality and conservatism might be interpreted differently by different accountants, which can lead to inconsistencies. Also, since there's no single set of uniform standards for conventions, different firms might interpret or apply them differently, making comparisons a bit tricky. Another point to consider is oversimplicity. Sometimes, conventions might oversimplify complex financial realities, which can affect the accuracy of the reports. And finally, conventions tend to be based on long-standing practices, so they might not keep pace with new business developments or technological advances, causing delays in updates. To sum up, accounting conventions are time-tested practices that bring structure, stability, and clarity to financial reporting. They help ensure that financial statements are not only accurate and complete, but also meaningful and trustworthy. These conventions shape how accountants behave and influence how stakeholders interpret financial information. Although they're not legally binding like formal standards, conventions are still vital for good accounting practice. When applied thoughtfully, they promote responsible and consistent presentation of financial results. At the same time, accountants need to remain flexible and update their practices as the economic environment, regulations, and technology evolve. In today's financial world, accounting conventions continue to be essential tools. They help us maintain the quality and integrity of financial reporting, ensuring that the information we rely on is both credible and useful. Let's delve into some fundamental concepts of accounting conventions. First, what is meant by an accounting convention? Essentially, it's an unwritten rule or practice that guides accountants in recording and presenting financial information consistently. Now, the convention of consistency is about maintaining uniformity in accounting methods over time. This helps users compare financial statements across different periods without confusion. The convention of full disclosure emphasizes transparency, ensuring all material information is disclosed so that stakeholders can make informed decisions. Next, the convention of conservatism encourages accountants to be cautious, especially when faced with uncertainty, so that profits are not overstated and liabilities are not understated. To give a couple of examples, we can consider the conventions of objectivity and materiality. Objectivity stresses using evidence-based data, while materiality focuses on disclosing information that could influence decisions. The purpose of accounting conventions is to promote reliability and comparability in financial reporting, making sure the financial statements truly reflect the company's position. The convention of materiality is particularly important because it helps accountants decide what information is significant enough to disclose, avoiding clutter that might obscure key insights. When comparing accounting concepts and conventions, concepts are fundamental assumptions, like going concern or accrual basis, while conventions are practical rules that guide application. Think of them as the bridge between theory and practice. The convention of prudence, or conservatism, guides us to record expenses and liabilities as soon as possible, but only recognize revenues when they are assured, thus avoiding overly optimistic reports. Finally, applying accounting conventions offers advantages like consistency, comparability, and credibility, which are essential for fostering trust among users of financial statements. Now, moving to Part B, where we explore these conventions in more detail. Explaining 5 conventions with examples helps us understand their practical relevance. Differentiating between concepts and conventions clarifies their roles in accounting. Briefly, the convention of full disclosure ensures transparency, while the convention of consistency maintains uniformity, both critical for reliable reporting. The convention of conservatism influences financial reporting by encouraging a cautious approach, preventing overstatement of profits. The convention of materiality ensures we focus on information that impacts decision-making, avoiding unnecessary clutter. Key features of accounting conventions include guiding principles that promote uniformity, transparency, and prudence. Consistency is vital because it allows users to compare financial data over periods, revealing true trends rather than methodological changes. Applying conventions in practice is necessary because they provide a standardized approach, ensuring that financial statements are clear and comparable. However, conventions also have limitations. They can sometimes be restrictive or outdated and might not fit every unique situation. Ultimately, accounting conventions support the objective of providing a true and fair view by promoting honesty, transparency, and comparability in financial reporting. Let's delve into the basics of accounting, specifically focusing on Part C, the 10 marks questions. First, let's understand what accounting conventions are. Essentially, they are the accepted practices and guidelines that ensure consistency, reliability, and comparability in financial statements. These conventions help maintain uniformity across different periods and organizations. Now, there are various accounting conventions, and it's important to explore some of them in detail. For example, the convention of conservatism encourages caution. It prompts accountants to record potential losses immediately, but only recognize gains when they are realized. This helps prevent overstatement of financial health. Another key convention is full disclosure, which mandates that all relevant financial information must be disclosed to stakeholders. This transparency builds trust and provides a complete picture of the company's financial position. The importance of these conventions lies in their role in preparing accurate and comparable financial statements. They ensure that financial data is presented consistently, making it easier for investors, creditors, and other users to analyze and compare performance over time. Let's also discuss how these conventions, like conservatism and full disclosure, influence the presentation of financial data. Conservatism tends to make financial statements cautious, avoiding over-optimistic figures, while full disclosure ensures that no significant detail is hidden. Both conventions promote honesty and clarity in financial reporting. It's also useful to compare accounting concepts and conventions. Concepts are fundamental principles like going concern or accrual, which underpin all accounting practices. Conventions, on the other hand, are practical guidelines that help implement these concepts consistently. An essential point to remember is that accounting conventions promote consistency and comparability, which are vital for reliable financial analysis. For example, using the same conventions across reporting periods makes it easier to track trends and assess performance accurately. Now, considering how conventions guide the preparation of final accounts, they help standardize procedures, ensuring that financial statements are prepared systematically and uniformly. This consistency is crucial for users who rely on these reports to make informed decisions. Of course, relying on conventions has its pros and cons. The advantages include improved comparability, reliability, and transparency. However, disadvantages might include rigidity. Sometimes conventions may hinder the recognition of unique or exceptional circumstances. Let's also see how the convention of materiality and conservatism help prevent misleading financial reporting. Materiality ensures that only significant information is emphasized, avoiding clutter or irrelevant data. Conservatism, as we discussed, prevents overstating assets or income, safeguarding against overly optimistic portrayals. Full disclosure, as per accounting conventions, is necessary because it ensures that users have all relevant information to make informed judgments, reducing information asymmetry. Finally, consistency plays a key role in the comparative analysis of financial statements over multiple periods. When companies apply the same conventions and policies consistently, it becomes easier to identify genuine trends and performance changes over time. In summary, these conventions and principles are vital for maintaining trust, transparency, and comparability in financial reporting, which ultimately supports sound decision-making. Let's go through some key concepts of the basics of accounting. First, financial accounting primarily deals with historical data, meaning it records past transactions and events, which helps us understand what has already happened financially. The main objective here is to provide financial information to external users, like investors and creditors, so they can make informed decisions. It's important to recognize what characteristics define financial accounting. For instance, it's based on a double entry system, ensuring that every debit has a corresponding credit, and it records only monetary transactions. Unlike management accounting, it's governed by standard rules called accounting standards, which promote consistency and transparency. Financial accounting plays a crucial role in preparing financial statements, such as the balance sheet and income statement, which communicate a company's financial position and performance. External users, like shareholders and investors, rely on these reports, unlike internal users such as managers or line supervisors. The practice is governed by generally accepted accounting principles, or GAAP, which set the standards for how financial information should be recorded and reported. Now, defining financial accounting, it's essentially a system designed to measure and communicate financial information to external users, giving them a clear picture of the company's financial health. One key objective is to provide relevant financial performance data, helping stakeholders evaluate how well the company is doing financially. Several important accounting concepts support this process. For example, the going concern concept assumes the business will continue operating indefinitely, which influences how assets and liabilities are valued. Another fundamental concept is the realization concept, which states that revenue should be recognized when it is earned, not necessarily when cash is received. This ties into the matching concept, which means expenses should be recorded in the same period as the revenues they help generate, providing a more accurate picture of profitability. Let's also touch on the cost concept, which requires assets to be recorded at their actual acquisition cost, not fluctuating market value. This ensures objectivity and reliability in financial reporting. Lastly, under the accrual concept, expenses are recognized when incurred, regardless of when the cash is paid, which aligns the recording of expenses with the period they relate to. By understanding these core principles and objectives, we can see how financial accounting provides a structured, standardized way to report and analyze a company's financial health, which is essential for transparency and decision-making. Let's take a closer look at some fundamental principles of accounting highlighted on this slide, starting with the business entity concept, which is crucial to understanding how we treat business and owner relationships. This concept implies that the owner and the business are considered separate entities. It helps ensure clarity in financial reporting by keeping personal and business finances distinct. Next, we have the concept that ensures our financial statements are prepared honestly. That's the verifiability concept. It emphasizes that financial information should be backed by evidence so that others can confirm its accuracy. Moving on, the conservatism convention advises caution in financial reporting. Essentially, it suggests that accountants should be conservative in estimating profits and assets to avoid overstating the financial position of the business. Then there's the materiality convention. This principle states that all significant information must be disclosed in financial reports, but trivial items, which don't impact decision-making, can be ignored to avoid cluttering the statements. The convention of consistency ensures that businesses use the same accounting methods year after year. This consistency helps users compare financial statements over different periods more reliably. The full disclosure convention requires that all relevant information, including liabilities and related party transactions, be fully revealed. Transparency is key here to provide a complete picture of the business's financial health. Finally, looking at objectives, one thing to note is that financial accounting aims to provide legal evidence and assist in audits, but it does not aim to predict business failure. That's not its primary objective. By understanding these concepts, we build a solid foundation for accurate and reliable financial reporting, which is essential for informed decision-making in any business. Today, we're going to explore the basics of accounting, starting with the introduction to the journal. In financial accounting, the journal is often called the Book of Original Entry. It's really the first place where all financial transactions are recorded in a systematic and chronological order. Think of it as the initial repository that captures every transaction before they're transferred to specific ledger accounts. This process is fundamental to establishing the double-entry bookkeeping system, ensuring every transaction affects at least 2 accounts. Each transaction, whether it involves cash or credit, impacts a minimum of 2 accounts. And this entire process, identifying, recording, and classifying transactions, begins with the journal. The journal accounts are essential because they help maintain accuracy, provide traceability, and create a clear audit trail for all financial activities. Understanding how the journal works is crucial because it forms the backbone of the entire accounting cycle and helps us keep our financial records transparent and organized. Now, let's look at what a journal really is. A journal is essentially a chronological record of financial transactions, where each is expressed in terms of debits and credits. Every transaction recorded here is called a journal entry. To give you some definitions, L.C. Cropper described a journal as a book where all day-to-day transactions are recorded in order. Carter, on the other hand, defined it as the Book of Original Entry, where transactions are first recorded before being posted to the ledger. The main objectives of maintaining a journal include systematic record keeping, making sure all transactions are recorded in an orderly, timed manner. It also serves as proof of transactions, which can be useful in case of disputes or audits. Each journal entry contains important details: the date, the accounts involved, the amounts, and a brief description or narration of what the transaction was about. Lastly, the journal makes it easier to transfer data to the ledger accounts, simplifying the process of posting and ensuring accuracy throughout the accounting cycle. All of these points highlight the journal's vital role in maintaining transparent, reliable financial records. Let's discuss the basics of accounting, focusing on error detection and the structure of a typical journal entry. Errors or omissions in recording transactions can often be identified and corrected before they are posted to the ledger. This helps maintain accuracy right from the start. Now, a typical journal entry has several key components. First, the date, which indicates when the transaction took place. Then, the particulars, where we list the affected accounts, starting with the debit side, followed by the credit side, which is preceded by to. For example, if we introduce capital into the business, it will be recorded with the date, the accounts involved, and the amounts. Ledger folio, or LF, is also important. It refers to the page number in the ledger where you can find the corresponding account. The amounts are shown in the debit and credit columns, reflecting the transaction value. And finally, there's the narration, a brief explanation of what the transaction is about, usually enclosed in brackets. The importance of maintaining a journal in financial accounting cannot be overstated. Journal entries serve as legal proof of transactions, providing an official record that can be used in case of disputes. They also promote transparency and control, ensuring that every transaction is recorded clearly and systematically. Moreover, the journal is the foundation for all ledger accounts. Every account in the ledger derives its data from these journal entries. This creates an audit trail that auditors and financial managers rely on for verification and ensuring compliance. Accurate journal entries also lead to reliable financial reporting, which is essential for making informed business decisions. As for the advantages, keeping a journal provides a chronological record of all financial activity, making it easier to trace and review transactions. It consolidates complete transaction details in one place, simplifying the process of auditing and verification. So, in summary, the journal is a crucial tool in accounting. It helps maintain accuracy, transparency, and accountability in financial recording. Let's now look at the basics of accounting, focusing on the journal and its role in the process. The journal helps us prepare final accounts by recording all business transactions in a systematic way. It also allows us to correct mistakes through what we call rectifying entries. However, there are some limitations to using a journal. For large businesses, manually recording every transaction can be quite time-consuming. Plus, if the business uses specialized subsidiary books, maintaining a detailed journal might become redundant. Errors can also slip through if entries are not posted properly to the ledger, and manual journalizing is prone to human mistakes. Additionally, manual systems lack real-time visibility, which can hinder quick decision-making. Now, let's talk about the different types of journals. In accounting, a journal is basically the original book of entry where transactions are recorded in the order they happen. Each transaction gets its own journal entry, and these entries are classified into various types based on their purpose. The main types include the purchase journal, also known as the purchase daybook. Its purpose is to record all credit purchases of goods that are meant for resale, such as inventory. It doesn't record cash purchases or asset purchases like machinery. For example, when you buy goods on credit from a supplier, you might record it as to supplier AC purchase of goods on credit. Next is the sales journal, or sales day book. This records all credit sales of goods. Cash sales, however, are not recorded here. For instance, when you sell goods on credit to a customer, you'd note it as to customer AC's sale of goods on credit. Then we have the purchase returns journal, also called the returns outward book. This is used to record returns of goods that were previously purchased on credit, usually due to defects or other issues. The entry might look like to purchase returns AC, returned defective goods. Finally, there's the sales returns journal, or returns inward book. This records the returns of goods sold, such as when a customer returns goods. These journals help us keep track of the flow of goods and payments, making our accounting clearer and more organized. Let's take a closer look at some of the basic accounting entries we use in everyday business. First, we have the sales returns account, which records goods that customers return after a sale made on credit. For example, when a customer returns goods, we make an entry to the sales returns account to reflect that. Next, we come to the cash journal, or cash book. This is essential because it records all cash and bank transactions, both money received and money paid out. The cash book can be subdivided into different types: the single column, double column, and triple column cash books, depending on how detailed we want to be. For instance, when cash is received from a debtor, we record it as a debit to the cash AC. And when cash is paid to a supplier, it's a credit to the cash AC. This helps us keep track of all cash movements clearly. Then there's the general journal, sometimes called the journal proper. This is where we record all those transactions that don't fit into other specific journals. Think of it as the catch-all for special or one-off entries like opening balances, closing entries, adjustments, depreciation, correcting errors, or transfer entries. For example, when we charge depreciation on machinery, we debit the depreciation AC. And when we adjust unpaid salaries, we debit salaries outstanding AC. These entries ensure our accounts reflect the true financial position. Finally, we have the bills receivable journal. This is used to record bills of exchange or promissory notes we receive from customers. For instance, when we receive a bill from a customer, we record it as a credit to the bills receivable AC. Understanding these different types of entries and journals helps us maintain accurate and organized financial records, which is the foundation of good accounting practice. Let's now discuss the bills payable journal, which is a crucial part of accounting. Its main purpose is to record all bills of exchange that the business either accepts or issues to creditors. Essentially, whenever your business accepts a bill for payment or issues one to a supplier, this journal captures that transaction. For example, if your business accepts a bill from a supplier, the entry would be to the bills payable account, indicating that the bill has been accepted for payment. This helps keep track of your liabilities related to bills of exchange. Looking at the bigger picture, this journal is one of several specialized journals we use. For instance, the purchase journal records credit purchases, while the sales journal captures credit sales. The purchase returns and sales returns journals handle returns of goods purchased or sold on credit. There's also the cash journal, which manages all cash and bank transactions, and the general journal for non-routine entries, adjustments, or corrections, such as depreciation or error corrections. The bills receivable journal, on the other hand, records receipts of bills from customers, and the bills payable journal, which we're focusing on now, records the issuance or acceptance of bills to suppliers or creditors. To make this clearer, let's look at an example. Suppose Mr. Ram starts his business on April 1st with $100,000 in cash. The journal entry would be to debit cash AC with rupee 100,000 and credit capital AC with the same amount. This shows the initial capital infusion into the business. So, understanding the bills payable journal helps us accurately record and track the obligations arising from bills of exchange, which are an important part of business transactions and financial management. Let's look at some basic accounting transactions through practical examples. First, consider the purchase of goods for cash. On April 5th, we bought goods worth 25,000 rupees and paid cash for it. The journal entry records this by debiting the purchases account and crediting the cash account, reflecting that cash decreased and inventory or purchases increased. Next, on April 8th, we sold goods worth 40,000 rupees on credit to Mr. Kumar. The journal entry here debits Mr. Kumar's account, showing that he owes us money, and credits the sales account, indicating revenue generated from the sale. Finally, on April 10th, we paid office rent of 5,000 rupees in cash. This is recorded by debiting the rent account and crediting the cash account, showing that cash was used to pay rent expenses. These examples illustrate the core idea of double entry bookkeeping. Every transaction affects at least two accounts, maintaining the accounting equation. Understanding these basic entries is fundamental as we build more complex financial records. Now let's look at two common transactions to understand the basics of accounting. First, on April 12th, a furniture purchase was made on credit. The journal entry records this by debiting the furniture account with 15,000 rupees, which shows an increase in assets. Simultaneously, we credit the MS Modern Furniture account, indicating that we owe this amount to the supplier. This entry reflects that we have acquired furniture without paying cash immediately, highlighting the importance of recording credit transactions properly. Next, on April 15th, we received a commission of 3,000 rupees in cash. The journal entry here involves debiting the cash account, showing an increase in our cash resources, and crediting the commission received account, which recognizes the income earned. These entries are fundamental because they help us keep track of how assets and income are affected by everyday transactions, forming the backbone of accurate financial recording. Connecting these points to the overall theme, understanding how to record such transactions correctly is essential for maintaining clear and reliable financial statements. It's these basic entries that build the foundation for more complex accounting processes. Today, let's look at some typical transactions that happen when starting a new business in April 2025. On April 1st, Mr. Ravi began his business by investing 2 lakh rupees in cash and goods worth 50,000 rupees. This initial investment is recorded as a capital introduction. Then, on April 3rd, he purchased goods on credit from MSABC Traders for 30,000 rupees. This is a purchase transaction that increases his inventory and creates a liability to pay later. Next, on April 5th, he made a cash sale of goods worth 40,000 rupees to Mr. Karan. This sale increases cash and recognizes revenue from sales. Finally, on April 8th, he bought office stationery for 2,000 rupees in cash, which is an expense. These transactions are recorded through journal entries, which help us understand how each business activity affects the accounts. For example, the initial capital is recorded by debiting cash and goods accounts and crediting the capital account. Purchases on credit are recorded by debiting purchases and crediting the supplier. Cash sales are recorded by debiting cash and crediting sales, while expenses like stationery are debited to the expense account and credited to cash. Understanding these entries is fundamental because they form the basis of maintaining accurate financial records and help us track the flow of money and goods in the business. Let's walk through some typical transactions related to fixed assets and expenses. On April 10th, the business purchased furniture for 25,000 in cash. This means we are acquiring a new asset, and the cash account decreases accordingly. Moving on April 12th, machinery was bought from MS Tech Machines for 100,000 on credit. Here, we record the machinery as an asset and create a liability until the payment is made. Then, on April 15th, wages of 10,000 were paid in cash. This expense reduces cash and is recorded in wages expense. Finally, on April 18th, we received Rupee 5,000 from Mr. Arjun as part of his outstanding account balance. This is a partial payment, so cash increases and his receivable decreases. The journal entries for these transactions clearly record the impact on accounts. For example, when furniture is purchased, we debit the furniture account and credit cash. Similarly, the machinery purchase is recorded with a debit to machinery and a credit to the creditor's account. Paying wages involves debiting wages expense and crediting cash. And when we receive a partial payment from Mr. Arjun, we debit cash and credit his account. These entries are fundamental because they help us track our assets, liabilities, and expenses accurately. Understanding these basics ensures we maintain proper financial records, which is essential for the overall health of the business. Let's go through some important transactions that involve discounts and owner drawings. On April 20th, we paid Rupee 29,500 to MSABC Traders, even though the total amount due was 30,000. The difference of Rupee 500 is recorded as a discount received, which benefits us by reducing the payable amount. Next, on April 22nd, we received Rupee 19,500 from Mr. Karen, although the full settlement was for 20,000. Here, we also record a 500 discount allowed, reflecting the amount we effectively received after the discount. Then, on April 25th, the owner withdrew cash and goods for personal use. First, we record a withdrawal of 5,000 cash, which reduces our cash balance and is shown as drawings. Simultaneously, the owner took goods worth Rupee 2,000, which we record as drawings too, but this time by reducing our purchases account to reflect the goods taken out. These transactions highlight how discounts affect our accounts and how owner withdrawals are recorded separately as drawings, impacting both cash and inventory or purchases. Understanding these entries helps us keep our books accurate and transparent. Now, let's look at some typical year-end adjusting and closing entries. On March 31, we have a few transactions to record that ensure our accounts reflect the true financial position. First, there's an outstanding salary of 8,000 rupees. This means we owe employees that amount, but it hasn't been paid yet, so we need to adjust for it. We do this by debiting salaries expense and crediting outstanding salaries liability. Next, we have prepaid insurance of 1,200 rupees. Since this insurance was paid in advance, we need to adjust the books to recognize the portion that has been used up by the end of the year. We debit insurance expense and credit prepaid insurance. Then, there's depreciation on machinery of 5,000 rupees. This is a non-cash expense that reflects the wear and tear on our machinery over time. We debit depreciation expense and credit machinery to account for this reduction in value. Finally, interest on capital of 2,000 rupees is being paid to the owner as a return for their investment. This is recorded by debiting interest on capital and crediting capital. These journal entries are essential because they help us match expenses and revenues accurately, following the matching principle in accounting. They ensure our financial statements provide a realistic picture of the company's financial health at year-end. Let's start with the basics of accounting, focusing on the journal, which is the first step in the accounting cycle. The journal is where all business transactions are recorded in a systematic and chronological order. It uses the double entry system, meaning every transaction affects at least two accounts, one debited and one credited. This method helps ensure accuracy and makes it easier to trace transactions later. Each entry in the journal is classified and recorded with proper debit and credit rules, which is essential for maintaining correct financial records. Think of the journal as the book of original entry. It's where everything begins before the data is transferred to ledger accounts, and then used to prepare the final financial statements. Its role is crucial for transparency, tracking all financial activities and preventing errors. Now, some common types of journal entries include the purchase journal, sales journal, cash book, and journal proper. These help organize different kinds of transactions effectively. Moving on to the questions you might encounter, like, what is a journal in accounting? A journal is simply a record of all transactions in chronological order. What is journalizing? It's the process of recording transactions in the journal. An opening entry refers to the initial recording when starting a new business. A compound journal entry involves more than two accounts. It's used for complex transactions. For example, a simple journal entry might be recording cash received from a customer. The narration in a journal entry explains the transaction briefly, providing clarity for future reference. The rule of debit and credit for personal accounts is debit the receiver, credit the giver. The golden rule for real accounts is debit what comes in, credit what goes out. The journal book functions as the primary record of all transactions, helping to keep the financial data organized and accurate. There are different types of journal entries, like simple and compound. Simple entries involve just two accounts, while compound entries involve multiple accounts. In terms of importance, the journal is vital because it provides a detailed, chronological record that forms the foundation for all other accounting records. Its features include simplicity and clarity, offering a clear trail for audit and verification. Recording transactions in the journal has the advantage of maintaining order and reducing errors. Let's consider some transactions and how they are recorded in the journal. For example, if a business starts with cash of rupee 50,000, the journal entry would reflect that initial cash inflow, helping us track the starting point of the business. Overall, mastering the journal and its proper use is essential for accurate and reliable accounting. It ensures transparency and provides a solid base for all subsequent accounting work. Let's look at some basic accounting transactions to understand how they are recorded. For example, when we buy goods for cash worth 10,000 rupees, we record it as a cash purchase. If we sell goods on credit to Ravi for 5,000 rupees, that gets recorded as a credit sale. Paying salaries of 2,000 rupees is an expense, and receiving a commission of 1,000 rupees is income. These simple entries help us track our financial activities. Now, a common question is, what is the difference between a journal and a ledger? The journal is the initial book of entry where transactions are first recorded in chronological order. The ledger, on the other hand, groups similar transactions into accounts, giving us a clear view of each account's balance. It's also important to understand the types of journal entries. There are various kinds, like simple entries, compound entries, and adjusting entries, each serving different recording needs. Learning how to write these entries correctly is essential, and it all begins with understanding the procedure of recording transactions in a journal. Moving on to Part C questions, let's define what a journal is. A journal is the primary book of entry where every transaction is recorded first, before being posted to the ledger. The format typically includes the date, particulars, debit and credit amounts, and narration. The procedure involves analyzing the transaction, deciding which accounts are affected, and then recording the entry in the journal. The journal is crucial because it acts as the original record of all financial transactions. For example, when we buy furniture for 15,000 rupees, we record it as a journal entry, ensuring accuracy and proper documentation. 6 journal entries, such as cash sales, purchases, and payments, illustrate this process vividly. Next, let's discuss the classification of accounts, such as assets, liabilities, income, and expenses, and the rules for debiting and crediting. For example, assets are debited when increased and credited when decreased, while liabilities are credited when increased. Understanding these rules helps us maintain balance in our accounts. To practice, imagine starting a business with a cash of 1 lakh rupees, purchasing furniture, buying goods from Ramesh, selling goods for cash, paying rent, paying Ramesh, and receiving money from Suresh. These transactions are recorded in the journal following proper procedures. Now, what exactly is a compound journal entry? It's an entry that involves more than 2 accounts, say, recording a transaction that affects 3 or more accounts at once. For example, a purchase that includes discounts and taxes. Throughout your accounting practice, you'll prepare journal entries for daily business transactions, like sales, purchases, payments, and receipts. These entries form the foundation of accurate financial records. Finally, remember that the journal is called the Book of Primary Entry because it captures transactions initially, before they are posted elsewhere. The format includes date, particulars, and debit and credit columns, with a brief narration explaining each entry. When comparing the journal and ledger, you'll see differences like their purposes, format, and how transactions are processed. The journal is for recording first, and the ledger is for summarizing. Recording transactions in a journal involves analyzing each transaction, deciding which accounts are affected, and then making the appropriate entries. This step is vital for maintaining correct records. And last, let's touch on the golden rules of accounting. These rules help us decide how to record transactions based on the type of account involved, whether it's a personal, real, or nominal account, with practical illustrations to clarify each rule. By understanding these fundamentals, you'll develop a solid grasp of how accounting records business activities accurately and systematically. Let's go through some key points about the basics of accounting, focusing on these multiple-choice questions to strengthen our understanding. First, consider what serves as a book of original entry. The correct answer is the journal, which is where all transactions are initially recorded. This is fundamental because it helps us keep track of every financial event in chronological order, ensuring accuracy and completeness. Next, journal entries are recorded in chronological order, which means in the sequence they happen. This makes it easier to trace transactions and verify records later. Moving on, when we look at cash AC, it's classified as a real account because it relates to tangible assets. Remember, real accounts deal with assets like cash, land, or equipment. Now, when a business purchases machinery, the correct account to debit is machinery, AC. This increases the asset and follows the debit rule for assets. Speaking of rules, the rule for personal accounts is to debit the receiver, which helps us identify who is receiving value in a transaction. Let's talk about compound journal entries. These involve multiple debits or credits within a single entry, often when a transaction has several aspects to record. An example might be paying cash for multiple expenses or receiving cash from multiple sources. When a sale is made on credit, it is recorded in the sales AC. This keeps track of our revenue from credit sales separately from cash sales. The journal itself is also known as the Book of Original Entry because it's where transactions are first recorded before posting to ledgers. If you pay rent, the account credited is usually the cash AC, since cash is going out. Journal entries include the date, narration, and sometimes ledger folio, so all relevant details are documented comprehensively. This is crucial for clarity and audit purposes. For goods returned by a customer, the correct entry is to debit return inward AC, which records the return of goods. And finally, when we receive commission, it's considered income, so we credit the commission received account, reflecting an inflow of revenue. By understanding these concepts, we're building a strong foundation in accounting, which is essential for accurate financial recording and reporting. Let's go through some basics of accounting with these key points. First, when cash is paid to creditors, it reduces liabilities because you're settling what you owe. So, the correct answer here is B, liabilities. Next, when you pay an electricity bill, the account affected is the electricity AC, since it records your expenses related to electricity. That means the right choice is a electricity AC. Now let's talk about discount allowed. This is actually a kind of expense because it reduces your revenue. Therefore, the correct option is B, expense. Moving on, trade discounts are recorded in the notepad or system, but not in formal accounting records like journals or ledgers. Typically, they are not recorded separately in the books, so the answer is C, not recorded. Regarding depreciation, the journal entry involves debiting the depreciation AC to recognize the reduction in asset value over time. So, the correct entry is B, depreciation AC doctor. When bad debts are written off, it affects your profit because it reduces the amount of income you can recognize. Thus, the impact is on profit, making a profit the correct choice. Wages paid are considered an expense since they represent costs incurred for labor. So, the right answer is B, expense. Finally, when goods are purchased on credit, the proper journal entry is to debit purchases AC, reflecting the increase in inventory or purchases. The correct answer is B, purchases AC doctor. These points are fundamental because they help us understand how transactions are recorded and their impact on financial statements. Keep these concepts in mind as they form the foundation of accounting. Now, let's explore the introduction to the ledger. In the accounting process, after transactions are initially recorded in the journal, the next important step is to post them to the ledger. The ledger is often called the book of final entry or the principal book of accounts because it consolidates all the financial data. Its main role is to organize this data into specific accounts, making it much easier to track, analyze, and summarize all transactions related to each account. The ledger also helps in preparing the trial balance, which is a key step before drafting the final accounts like the trading account, profit and loss account, and the balance sheet. So, essentially, the ledger acts as the backbone of the entire financial accounting system, providing structure and clarity. Now, what exactly is a ledger? It's a book or a digital record that contains all the individual accounts, such as assets, liabilities, capital, income, expenses, and these are classified and summarized. Each account within the ledger shows the complete history of transactions affecting it, which makes it easier to determine the current balances and monitor how well the business is performing. To put it simply, a ledger is a comprehensive record that helps us see the financial story of each account clearly. The formal definition tells us that it's a book that contains all the accounts related to the business, with transactions from the journal classified and posted under the correct headings. Let's look at some key features of a ledger. First, it classifies all transactions under specific account heads like cash, sales, rent, purchases, and so on. This classification makes it easier to understand where the money is coming from or going to. Second, entries are posted in the same order as they occur in the journal, which helps maintain a clear chronological flow. Next, the dual aspect principle is very important. Every debit recorded in one account has a corresponding credit in another. This keeps the accounting equation balanced. The ledger also provides closing balances for each account, which are used in preparing financial statements. And finally, each account follows a standard format, ensuring clarity and consistency across all records. In summary, the ledger is an organized, systematic record that plays a vital role in maintaining accurate and comprehensive financial information. Let's delve into the objectives of maintaining a ledger. The primary goal is to systematically record all financial transactions under the appropriate account headings. This helps us keep a clear and organized record of every financial activity. Another key objective is to determine the individual balances of assets, liabilities, incomes, and expenses. Knowing these balances is crucial for understanding the financial position of the business at any given time. The ledger also plays a vital role in preparing the trial balance and the final accounts. It serves as the backbone for compiling accurate financial statements. Additionally, maintaining a ledger aids in error detection and fraud prevention. By reviewing and reconciling accounts periodically, discrepancies can be identified and corrected promptly. Lastly, a well-maintained ledger provides detailed insights into the financial health of the business, helping stakeholders make informed decisions. Now let's talk about the format of a ledger account. Typically, it's maintained in what we call the T-account format. Imagine a T-shaped table divided into two sides. On the left side, we record the date, particulars, journal folio or JF, and the debit amount. On the right side, we note the date again, particulars, JF, and the credit amount. For example, if we look at a transaction where capital is introduced, the date, the account involved, the journal reference, and the amount are recorded in the debit side. Conversely, when expenses like rent or purchases are made, those are recorded on the credit side with similar details. This structured format makes it easy to track transactions, verify balances, and ensure accuracy in our accounting records. It's a fundamental tool that supports the entire accounting process. Let's now look at the basics of accounting, specifically the types of ledgers. There are three main types we need to understand. First, the general ledger. This is the primary ledger that contains all the real, nominal, and personal accounts. Think of it as the central repository for all your accounting information. It plays a crucial role because it's used to prepare the trial balance, which helps ensure that everything balances correctly. Next, we have the debtor's ledger, also known as the sales ledger. This ledger records all the accounts of credit customers. It's very helpful because it allows you to track how much each customer owes and monitor the status of receivables. Then we have the creditor's ledger, or the purchase ledger. This one records transactions with suppliers from whom you purchase goods or services on credit. It helps you keep track of your payables and due dates, ensuring you pay your suppliers on time. Moving on, let's talk about the classification of ledger accounts. Broadly, ledger accounts are divided into 3 categories. The first is personal accounts, which relate to individuals, firms, or organizations. For example, Rams account or MSABC Limited. Account. The key rule here is to debit the receiver and credit the giver. The second category is real accounts, related to tangible and intangible assets. Examples include cash, furniture, or building accounts. The rule for these is debit what comes in and credit what goes out. The third category is nominal accounts, which deal with expenses, losses, incomes, and gains. Examples are rent, salary, or commission accounts. The rule here is to debit all expenses and losses and credit all incomes and gains. Finally, let's discuss posting to the ledger. This is the process of transferring journal entries into their respective ledger accounts. Since each transaction affects at least 2 accounts, one debit and one credit, both sides must be posted correctly. For example, if on April 1st you record a journal entry debiting cash for 50,000 rupees, you then post that amount to the cash account in the ledger. This process ensures your accounts stay accurate and up to date. Let's start by looking at the basics of accounting, specifically how we record capital introduced into the business. Here, we see that the capital account is credited with rupee 50,000, indicating that this amount has been introduced as capital. When we do ledger posting, this transaction affects both the cash account and the capital account. On April 1st, we record the capital in the capital account with a credit of 50,000, and correspondingly, we debit the cash account with the same amount. Now moving on to the balancing of ledger accounts. At the end of an accounting period, it's essential to balance each ledger account to find out the closing balance. The process involves a few simple steps. First, add up both the debit and credit sides. Then, find the difference between the 2 totals. If one side has a lesser total, we enter that difference on that side as balance CD, which means balance carried down. This balance then becomes the opening balance for the next period, entered as balance BD, or balance brought down. Let's look at an example with the cash account after balancing. On April 1st, the account shows a debit of 50,000 from the capital introduced. After accounting for all transactions, suppose the balance on April 30th is rupee 40,000. We record this as balance CD, meaning that rupee 40,000 remains in the cash account at the end of the period. On May 1st, this balance of 40,000 is brought forward as balance BD, the opening balance for the next period. The key takeaway here is that balancing helps us determine the closing balances of accounts, which are crucial for preparing accurate financial statements. It's a fundamental part of the accounting cycle, ensuring our records are complete and accurate. Now, let's explore the importance of the ledger in accounting. The ledger serves as the foundation for preparing final accounts because it is the main source for creating the trial balance and the final financial statements. It helps us organize all transactions systematically under the correct account heads, making it easier to track and analyze financial data. The ledger also plays a crucial role in performance monitoring. By reviewing individual account balances, we can assess income versus expenditure and assets versus liabilities. This ongoing oversight is vital for effective financial management. Another key aspect is internal control. The ledger aids in detecting and preventing fraud, errors, or inconsistencies in the records, ensuring the integrity of our financial information. Additionally, it supports compliance by providing a clear audit trail, which is essential for regulatory checks and tax filings. Now, let's quickly look at how the journal differs from the ledger. The journal is our book of original entry, where transactions are recorded in chronological order. The ledger, on the other hand, is our book of final entry, where we classify and summarize these transactions under specific accounts. In terms of format, Journal entries are made in a simple, chronological manner, while the ledger uses T accounts, which organize information account-wise. The journal focuses on the sequence of transactions, whereas the ledger provides us with the balances of each account. With technological advancements, modern ledgers are now digital. Most businesses use accounting software like Tally, QuickBooks, or SAP. These systems automate the posting process, give real-time balances, and significantly reduce human error. They also enable multi-user and cloud-based access, making accounting more flexible and efficient. Despite these technological changes, the core principles and structure of ledger accounting, manual or digital, remain fundamentally the same. It's all about maintaining accurate, organized, and accessible financial records to support sound business decisions. Let's look at the first illustration, which is about the introduction of capital. On April 1, Mr. Ramesh started his business with a cash amount of Rupee 100,000. This is a common initial transaction where the owner invests money into the business. The journal entry for this transaction records the increase in cash by debiting the cash account with Rupee 100,000, and it also shows that this amount is credited to the capital account, reflecting the owner's equity in the business. When we post this to the ledger, the cash account shows a debit of Rupee 100,000, indicating cash coming into the business, and the capital account will show a credit of Rupee 100,000, representing the owner's investment. Now, moving to the second illustration, which involves a cash purchase. On April 3, Mr. Ramesh purchased goods worth Rupee 25,000 in cash. This transaction decreases cash, so in the journal, we debit the purchases account with Rupee 25,000 to record the acquisition of goods, and we credit the cash account by the same amount to show the cash paid out. This example highlights how cash transactions are recorded in the books, with the purchases account increasing and cash decreasing accordingly. Both these illustrations help us understand the core principles of recording transactions, debiting what comes in or increases and crediting what goes out or decreases. These are fundamental to maintaining accurate and balanced accounting records. Let's look at some basic accounting entries related to purchases and sales. First, on April 3, there was a purchase of goods paid in cash. The journal entry shows that the cash account is debited with 25,000 rupees, and the purchases account is credited with the same amount. This reflects the increase in purchases and the outflow of cash. Moving on, we have an illustration of cash sales. On April 5, goods worth 40,000 rupees were sold for cash. The journal entry here records a debit to the cash account with 40,000 rupees and a credit to the sales account with the same amount. This indicates that cash has increased due to the sale, and revenue from sales has also increased. Finally, on April 7, there's a credit purchase. The business bought goods worth 30,000 rupees on credit from MSXYZ. Notice that in this case, the entry would involve debiting the purchases account and crediting the accounts payable or the supplier's account, showing that the purchase was made on credit rather than cash. These transactions highlight fundamental principles, how purchases and sales are recorded, whether paid in cash or on credit, and the importance of understanding how these entries impact the accounts. They form the foundation of keeping accurate financial records, which is essential for any business. Let's go through the basics of accounting with some simple transactions. First, consider the purchase of goods on credit. When we buy goods worth Rupee 30,000 from MSXYZ on credit, we record this in our books by debiting the purchases account and crediting MSXYZ's account. This shows that our purchases have increased, and at the same time, we owe money to MSXYZ. Now, looking at the journal entries, the date is April 7. We debit the purchases account with 30,000 and credit MSXYZ account with the same amount. This reflects the purchase transaction clearly. Moving on to the purchases account table, you see the date, particulars, journal folio, and the amount. On April 7, the entry shows the purchase from MSXYZ, confirming the transaction. Similarly, MSXYZ account is updated with the corresponding credit entry. This keeps our ledger balanced and shows that the liability to MSXYZ has increased. Next, let's look at a credit sale example, which is illustrated here. On April 9, we sold goods worth rupee 20,000 on credit to Mr. Kumar. The journal entry for this sale records a debit to Mr. Kumar's account and a credit to the sales account. This indicates that we have made a sale, and Mr. Kumar now owes us rupee 20,000. In the Mr. Kumar account table, the date and particulars are shown with the debit entry, confirming the receivable. On the sales account side, we record the credit for the same amount, reflecting the revenue earned from this transaction. These entries are fundamental because they help us track what we owe and what is owed to us, forming the backbone of proper accounting records. They also illustrate how transactions are reflected in both the ledger and journal, ensuring our books stay balanced and accurate. Let's look at some basic accounting entries through practical examples. On April 10, we paid office rent of 5,000 rupees in cash. The journal entry for this transaction involves debiting the rent account and crediting the cash account. This is recorded as rent AC Dr. 5,000 and cash ACCR 5,000. The debit increases the rent expense, while the credit decreases our cash balance. Now, moving to the second example, on April 12, we received a cash commission of 2,000 rupees. Here, the journal entry is straightforward. We debit the cash account and credit the commission account. This reflects an inflow of cash from the commission earned. These examples highlight the core principle of double entry bookkeeping. Every transaction affects at least two accounts, maintaining the accounting equation's balance. By recording these entries carefully, we ensure our books correctly reflect the financial activities of the business. Now, let's look at some basic accounting entries related to a commission account. On this slide, we see a table illustrating the recording of transactions. For example, on April 12, there is a receipt of cash amounting to 2,000 rupees, which is recorded as a debit in the cash account. This shows how cash received is entered into the books. Next, we move to illustration 18, which involves the owner's drawings. On April 15, Mr. Ramesh withdrew 3,000 rupees for personal use. The journal entry for this transaction debits the drawings account and credits the cash account. This reflects that the owner took cash out of the business, which reduces the cash balance and increases the drawings. The drawings account table confirms this entry, showing the debit entry of 3,000 rupees on April 15. Similarly, the cash account records this transaction as a credit on the same date, indicating cash leaving the business. Now let's look at illustration 19, which addresses wages paid. On April 17, the business paid wages of 4,000 rupees in cash. The journal entry debits wages AC and credits cash AC, signifying that wages expense is recognized and cash decreases accordingly. This transaction is also reflected in the cash account, where the credit entry of 4,000 rupees on April 17 confirms the cash outflow. Overall, these examples highlight key accounting principles, recording cash transactions, owners' withdrawals, and expenses like wages. Understanding these entries is essential because they form the foundation of maintaining accurate financial records. They help us see how each transaction affects different accounts, ensuring our books stay balanced and true to reality. Now, let's look at some basics of accounting through these examples. First, we see the wages account. On April 17th, a payment of 4,000 rupees was made in cash for wages. The journal entry records a debit to the wages account and a credit to the cash account, reflecting that wages are an expense paid out in cash. Next, we have an illustration of machinery purchased on credit. On April 20th, the company bought machinery worth 50,000 rupees from MS Tech Machines. The journal entry here debits the machinery account, indicating an increase in assets, and credits MS Tech Machines account, showing the company's liability. This transaction is also reflected in the respective ledger accounts. The machinery account shows a debit of 50,000 rupees, and the MS Tech Machines account records a corresponding credit. These entries exemplify how transactions are recorded systematically, ensuring accuracy and clarity in the company's financial records. Remember, understanding these basic journal entries helps us comprehend how transactions flow through the accounting system, maintaining the integrity of our financial statements. Let's take a closer look at slide 53, which covers the basics of accounting, specifically focusing on the ledger. The ledger is one of the most vital tools in the entire accounting cycle. It serves as a systematic record where all transactions are organized and classified. By doing so, it provides a clear and comprehensive view of each financial aspect of the business. The ledger reflects the balances of all accounts, whether assets, liabilities, equity, income, or expenses. This organized structure makes it easier to prepare final accounts accurately and to assess the financial performance and position of the enterprise. Basically, it acts as the backbone of financial reporting. Mastering ledger accounting is crucial. Whether you're an accountant, a finance professional, or a business owner, understanding how the ledger works is fundamental to effective financial management and control. It helps in maintaining accuracy and transparency in financial records. Now, the slide also hints at some common questions you might encounter. For instance, what exactly is a ledger? Well, it's the main record where all transactions are posted after they are initially recorded in the journal. Then, there's posting itself, referring to the process of transferring journal entries into the ledger accounts. We also need to understand what a ledger folio is, which is basically a reference number linking a journal entry to its corresponding ledger entry. Knowing different types of ledger accounts, like personal, real, and nominal accounts, is also important. And of course, balancing accounts is a key process to ensure records are correct. The slide emphasizes the differences between the journal and the ledger, highlighting their roles in the accounting cycle. Remember, the journal is where transactions are initially recorded, while the ledger is where these transactions are classified into individual accounts. Understanding the debit and credit sides of a ledger is fundamental, knowing which side increases or decreases each account type. For example, assets increase on the debit side, while liabilities increase on the credit side. Additionally, knowing some common personal accounts, such as accounts payable or receivable, helps in classifying transactions correctly. Overall, the purpose of the ledger is to provide a detailed, organized, and accurate record of all financial transactions, which is essential for financial analysis and decision-making. Finally, understanding nominal accounts, like expenses and revenues, is crucial because they help in calculating the net profit or loss. The slide also prompts questions about the importance of classifying ledger accounts and the rules of debit and credit that apply to different types of accounts. In essence, mastering these concepts ensures that your accounting system remains accurate, organized, and useful for making informed business decisions. Let's begin by understanding what a ledger is. A ledger is a principal book of accounts where all the financial transactions of a business are recorded in a systematic way. It acts as the main record that summarizes all the transactions from various books like the journal. Its features include the use of debit and credit sides, a clear format with account titles, and a procedure for posting, which involves transferring entries from the journal to specific ledger accounts. To illustrate this, imagine you start a business with rupee 50,000 on January 1st. This entry is posted to your capital account in the ledger. Now, let's look at preparing ledger accounts for some transactions. For example, when you purchase furniture worth rupee 10,000 on January 3rd, you would debit the furniture account and credit the cash or bank account. When you sell goods worth rupee 15,000 to Kumar on January 5th, you credit your sales account and debit Kumar's account. Paying rent of 2,000 on January 8th involves debiting rent expense and crediting cash. Receiving rupee 5,000 from Kumar on January 10th means debiting cash and crediting Kumar's account. Moving on, it's important to distinguish between the journal and the ledger. The journal is the book of original entries where transactions are first recorded in chronological order. The ledger, however, consolidates all these entries into specific accounts, making it easier to see the balances and summaries. That's why the ledger is often called the king of all books, because it provides the complete picture of the financial position of the business. Next, let's discuss the classification of ledger accounts. These are generally grouped into assets, liabilities, capital, income, and expenses. For example, asset accounts include cash or furniture, liability accounts include loans payable, income accounts include sales, and expense accounts include rent or utilities. This classification helps in analyzing and understanding financial health more effectively. Balancing of accounts is another key concept. It involves calculating the difference between the debit and credit sides of an account to find the closing balance. For example, if your cash account shows total debits of 20,000 and credits of rupee 15,000, the balance is 5,000 on the debit side. Balancing is done by subtracting the smaller side from the larger and writing the difference on the side of the larger, which then becomes the closing balance. The importance of the ledger in the accounting cycle cannot be overstated. It helps in summarizing all transactions, preparing financial statements, and ensuring accuracy through trial balances. Its role is vital because it provides a clear, detailed, and organized record of all accounts. Now, let's prepare 5 ledger accounts with some imaginary journal entries. Suppose we have a cash account, sales account, furniture account, rent expense, and Kumar's account. Each will reflect the respective transactions, such as cash received, sales made, furniture purchased, rent paid, and money received from Kumar, all posted from journal entries. It's also essential to understand the relationship between the journal, ledger, and trial balance. The journal records initial transactions. These are then posted to the ledger, which summarizes them into individual accounts. The balances from these accounts are used to prepare a trial balance, ensuring that the total debits equal total credits, which is a check on accuracy. In modern accounting systems, the ledger functions have evolved with technology. Automated systems now enable real-time posting, easy updating, and error detection. The functions remain the same, recording, classifying, and summarizing, but they are now faster and more efficient. Finally, when we say ledger is the principal book of accounts, we mean that it holds the detailed record of all transactions in individual accounts. It provides the foundation for preparing financial statements and analyzing financial performance, which justifies its central role in accounting. Now, moving to some multiple-choice questions. The ledger is called the final book of accounts, the source of all financial data, and it shows debits on the left side. A credit in a ledger account generally indicates a decrease in assets or an increase in liabilities and income. The sales ledger contains accounts of customers, helping manage credit sales and receivables. That covers the key points about the basics of accounting related to the ledger. Remember, understanding the ledger's role and how it connects with other accounting books is crucial for maintaining accurate financial records. Let's go through some fundamental concepts of accounting that are essential for understanding how financial information is recorded and organized. First, which account has both debit and credit entries? The correct answer is all accounts, but specifically, this highlights that most accounts, especially ledger accounts, are affected by both debits and credits over time. Next, ledger folio refers to the ledger page number where a particular account is recorded. It's important because it helps us locate accounts quickly and ensures proper cross-referencing within our books. Posting is a key step in the accounting process. It involves transferring entries from the journal to the ledger. This step helps in organizing transactions by accounts, making it easier to analyze financial data. When we talk about a credit balance, it generally indicates a liability, income, or sometimes a capital account. It's a sign that the account has more credits than debits, which is crucial for understanding the financial position. A typical ledger account format includes several components: the date, particulars or description of the transaction, and the debit or credit amount. All these elements together make the account clear and detailed. The cash account usually has a debit balance because cash is an asset. When cash is received, it increases, so debits are recorded here. Posting from the journal to the ledger is done regularly, often daily or weekly, to keep the books up to date and accurate. This regularity ensures timely financial information. When capital is introduced into the business, it is recorded on the credit side of the capital account, reflecting an increase in owner's equity. Wages paid are posted to the wages AC as a debit, indicating an expense incurred and cash or bank outflow. Similarly, rent received is posted to the rent AC as a credit, since it increases income. Ledger accounts play a vital role in preparing the trial balance, which is a summary of all ledger balances. It helps verify that debits equal credits, ensuring the books are balanced. Credit purchases, such as buying goods on credit, affect the purchase's AC by debiting it, indicating an increase in purchases. Finally, the ledger helps in recording, classifying, and summarizing financial transactions, which makes it an indispensable tool for maintaining organized and accurate financial records. Understanding these basics helps us grasp the entire accounting process, from recording transactions to analyzing financial health. Now let's move on to some basics of accounting. On this slide, we see a table that highlights key concepts. First, let's look at the question about ledger accounts. It asks, ledger account is opened for, and the options are A, each transaction, B, each account, C, each voucher, or D, each invoice. The correct answer is B, each account. This means that for every individual account, be it cash, sales, or expenses, a separate ledger account is maintained. This helps us track all the transactions related to that specific account. Next, we have the question about credit entries in the capital account. When we see a credit entry there, it typically indicates a reduction or a certain type of change in the capital. The options are A, profit, B, loss, C, liability, or D, income. The correct answer is C, liability. Although it might seem a bit counterintuitive at first, crediting the capital account generally signifies an increase in liabilities or reductions in owner's equity, depending on the context. Below that, we have a series of questions with answers, numbered from 1 to 20. These are likely test questions to reinforce learning. For instance, the answers range from options A to D, covering various fundamental principles. While we won't go through each one now, the key takeaway is understanding how these answers reflect core accounting principles and the importance of accuracy in recording transactions. Overall, these points emphasize the importance of maintaining proper ledger accounts for each individual account and understanding the implications of credit entries in different accounts, both critical concepts in mastering the basics of accounting. Now, let's explore the basics of accounting with a focus on subsidiary books. In any business, transactions are first recorded in a book of original entry. Typically, we use a journal as the primary record for all financial transactions. However, as the volume of transactions grows, managing everything in a single journal can become quite challenging and time-consuming. To address this, we introduce subsidiary books, also called special journals. Subsidiary books are specific journals maintained to record transactions of similar nature in a systematic and efficient way. Instead of cluttering one general journal with all kinds of transactions, we classify them and record them in different subsidiary books. Examples include the cash book, purchases book, sales book, purchases returns book, sales returns book, bills receivable book, bills payable book, and journal proper. Each of these books serves a particular purpose and helps us record data quickly and accurately. Using these books enhances operational efficiency and reduces errors. They also allow multiple accountants to work simultaneously without confusion, which is especially beneficial for medium and large businesses where transaction volume is high. Now, what exactly are subsidiary books? They are special journals used for recording day-to-day transactions of a similar kind, organized in a systematic and categorized manner. Instead of recording everything in one place, we classify and record transactions in different books to make the process easier and more efficient. The importance of subsidiary books cannot be overstated. They help divide the workload among accounting staff, making the process more organized. They enable quick and easy recording of transactions, which saves time. Additionally, they help prevent errors and omissions, and because the data is organized, it's much easier to locate specific information when needed. In essence, subsidiary books are an essential part of a well-structured accounting system, especially for businesses with a high volume of transactions. They streamline the process, improve accuracy, and support efficient management of financial data. Let's now look at the main types of subsidiary books in accounting. These books help us record different types of transactions systematically. Starting with the cash book, it records all cash and bank transactions, and sometimes it includes a discount column to track any discounts offered or received. There are different types of cash books, such as single, double, or triple column, depending on the level of detail needed. Next is the purchases book, which specifically records all credit purchases of goods intended for resale. It's important to note that cash purchases are not recorded here. Those are logged directly into the cash book. Moving on, we have the sales book, which records only credit sales of goods. Cash sales are, again, recorded directly in the cash book. The purchase returns book, also called the return outwards, is used to document goods that are returned to suppliers. This helps keep track of returned goods that were previously purchased on credit. By maintaining these subsidiary books, businesses can organize their transactions efficiently, making it easier to prepare financial statements and analyze business performance. This systematic recording supports the overall theme of maintaining accurate and organized financial records. Let's go through some of the fundamental aspects of accounting with this slide. First, we have the sales returns book, also known as the return inwards book. This is used specifically to record goods that customers return. It's an important record because it helps us keep track of returned items and adjusting sales figures accordingly. Next, we come to the journal proper. This book records all entries that don't fit into other specific books. For example, opening and closing entries, adjustment entries, and rectification entries are all recorded here. It acts as a catch-all for miscellaneous journal entries. Moving on, we have the bills receivable and bills payable books. These are used to record details of bills drawn and accepted, such as bills of exchange, which are common in business transactions involving credit. Now, let's look at the advantages of using subsidiary books. First, they save us time and effort because transactions are recorded systematically in specific books. They also enable division of work and specialization, making the process more efficient. Additionally, subsidiary books serve as quick references during audits and internal controls. Lastly, they help minimize errors and omissions, enhancing the accuracy of our financial records. To illustrate, let's examine an example from the purchases book. On March 5, we purchased 10 bags of rice from Ram & Co. at $500 each. Then, on March 7, we bought 5 bags of wheat from Kishore stores at $700 each. All these purchases were made on credit. In the purchases book, we record the date, the supplier, the invoice number, and the amount. For these transactions, the total purchase amount is Rs500. Similarly, in the sales book, we record credit sales. On March 6, we sold 15 bags to Ravi Traders at $400 each, and on March 10, we sold 10 bags to Suresh Agencies at $450 each. These entries help us keep a clear record of all our credit sales, ensuring accurate tracking of our receivables. By maintaining these subsidiary books diligently, we streamline our accounting process, improve accuracy, and facilitate easier audits and internal control checks. Let's go through some basic accounting entries today. On this slide, we see a purchase book example. It records purchases made on specific dates, like Ravi Traders on March 6th for $6,000 and Suresh Agencies on March 10th for $4,500, totaling Rs10,500. This helps us keep track of all purchases made during a period. Next, we have the illustration of a purchase returns book. Suppose we return goods, like on March 15th, when 2 bags valued at Rs500 each, because they were defective, are returned to Ram & Co. This transaction is recorded with a debit note of Rs1,000, reflecting the return amount. This process ensures our books reflect the actual inventory and outstanding liabilities. Moving on, we see the sales returns book. For example, on March 18th, Suresh Agencies returned 2 bags, each costing Rupee 450. The total return amount is Rupee 900, recorded with a credit note. This entry helps us track returns, which reduce our sales revenue and adjust our receivables accordingly. Finally, this slide shows a cash book, which is a single-column record of cash transactions. Starting with Rupee 10,000 in hand on March 1st, we record a cash sale of 5,000 on March 2nd and wages paid of 2,000 on March 3rd. The closing balance after these transactions is Rupee 13,000. These examples highlight how different books, purchase, sales returns, and cash help us maintain clear, accurate records of our financial activities, which is fundamental to good accounting practice and overall financial management. Let's look at some basic accounting concepts through these illustrations. First, we have the bills receivable book. On March 8th, Rakesh has sent us a bill for 5,000, which is due after 2 months on May 8th. This means we are expecting to receive this amount in the future, and recording this helps us keep track of our receivables. Next, we have the bills payable book. On March 10th, we accepted a bill from Anil for 3,000, payable after 3 months, by June 10th. This indicates a liability, as we owe this amount and need to record it properly in our books. Finally, let's examine the opening entry in the journal proper. We start with assets, cash of 10,000 and furniture worth Rupee 5,000, and liabilities, which include our capital account of 15,000. The journal entry balances these assets and liabilities, bringing forward the opening balances. These examples highlight how different transactions are recorded in accounting books, helping us maintain an accurate picture of our financial position. Keeping track of bills receivable and payable ensures transparency and proper management of our cash flow. The opening entry sets the foundation for the accounting period, showing what we start with at the beginning of our accounting cycle. In this slide, we're looking at 2 important illustrations that help us understand the process of recording transactions accurately in the journal proper. First, we have the compound entry example, where a single payment covers both rent and electricity. So, on March 12, the entry shows that we debit rent AC with 2,000 rupees and electricity AC with 1,000 rupees, because these are expenses we've incurred. The credit side is the cash AC, which is credited with 3,000 rupees, reflecting the payment made in cash. The key point here is that when multiple expenses are paid at once, we record them with a compound entry to keep our books clear and organized. Next, we see a rectification entry. Sometimes, errors happen, like posting wages wrongly to the salaries AC here. On March 14, we debit wages AC with 1,000 rupees and credit salaries AC with the same amount to correct the mistake. This ensures our records are accurate and reflect the true nature of the transactions. Finally, I want to highlight the importance of subsidiary books in overall accounting. They're essential tools, especially when dealing with a high volume of transactions. They help us organize and categorize transactions efficiently, improve accuracy, and prevent errors. Each book serves a specific purpose, and together, they form the backbone of double entry bookkeeping. Using subsidiary books makes the entire accounting process smoother, more reliable, and compliant with financial reporting standards. They also facilitate the timely preparation of trial balances and final accounts by maintaining real-time, structured records that are easy to access and review. Let's explore the basics of accounting, focusing on Book Back Questions Part A, which covers 2 marks questions. First, what are subsidiary books? These are special books used to record specific types of transactions, helping organize and simplify the recording process. Examples include the purchases book, sales book, cash book, and bills receivable and bills payable books. Now, what do we record in the purchases book? It primarily records all credit purchases of goods. Moving on, journal proper refers to the section where transactions that don't fit into other subsidiary books are recorded. such as opening entries, adjustments, and closing entries. The purchase returns book is used to record goods returned to suppliers. It helps keep track of all such returns separately. In the cash book, we record all cash transactions, both receipts and payments, serving as a combined record for cash inflows and outflows. Next, the sales returns book records goods returned by customers, which is essential for tracking return transactions separately from sales. Bills receivable and bills payable books are used to record bills received from customers and bills issued to suppliers, respectively, helping manage credit transactions. A key difference between the sales book and the sales returns book is that the sales book records new sales, while the sales returns book records goods returned by customers. Using subsidiary books offers advantages such as better organization, easier tracking, and reduced errors. Moving to Part B, which involves 5 marks questions. Subsidiary books are important because they streamline recording, help in maintaining accurate records, and facilitate easier audits. Distinguishing between purchases and sales books. Purchases book records credit purchases, whereas sales book records credit sales. Similarly, purchase returns and sales returns books record the return of goods to suppliers and from customers, respectively. The cash book serves as both a record of cash receipts and payments, often formatted with columns for date, particulars, receipts, payments, and balance. Journal proper functions include recording transactions that are not suited to other subsidiary books, like opening entries, adjustments, or closing entries. Bills receivable and bills payable books help track credit bills, ensuring proper management of receivables and payables. Maintaining subsidiary books offers advantages such as easier data retrieval, clearer control over transactions, simplified posting to the ledger, and better accuracy. Let's look at specimen formats briefly, such as the sales book and purchases book, highlighting their columns for date, invoice number, party name, and amount. The formats help standardize recording and ensure consistency. Differentiating between journal and subsidiary books. Journals record all transactions in chronological order, serving as the primary book of entry, while subsidiary books categorize transactions to streamline recording. Now, moving into Part C, which covers 10 marks questions. Subsidiary books are specialized books for recording specific types of transactions, and examples include the purchases book, sales book, cash book, bills receivable, and bills payable books. Each serves a unique purpose and helps organize financial data efficiently. Advantages of subsidiary books include better organization, ease of reference, reduced errors, and simplified posting to the ledger. However, limitations may include the need for careful maintenance and the risk of discrepancies if not properly managed. We also prepare detailed formats for the purchases book, sales book, and cash book, explaining their contents, date, invoice number, particulars, and amounts, which help ensure accurate recording. When comparing the sales book and sales returns book, remember that the former records new sales, contributing to revenue, while the latter records returns, affecting sales figures and inventory. Finally, journal proper plays a crucial role by recording transactions that don't fit elsewhere, like adjustments, opening balances, and closing entries, making it a vital component of comprehensive accounting. Let's explore the basics of accounting, focusing on subsidiary books and their role in financial recording. Subsidiary books are specialized journals used to record specific types of transactions, which helps keep the main ledger clear and organized. For example, the bills receivable and bills payable books are 2 key subsidiary books. The bills receivable book records all bills owed to the business, such as bills accepted by customers, while the bills payable book tracks bills the business has to pay, like those issued to suppliers. Now, these books have distinct features. They follow a specific format, typically including details like the date, bill number, party's name, amount, and due date. The purpose of maintaining these books is to simplify the recording process, ensure accuracy, and facilitate easy reference and verification later on. In large organizations, maintaining subsidiary books becomes even more crucial. They often employ a systematic approach, such as separate books for different types of bills or transactions, so that large volumes of transactions are recorded efficiently and accurately. To get a practical understanding, you can practice by creating dummy transactions, like a bill received from a supplier or a bill accepted from a customer, and then entering these into the respective subsidiary books. This exercise helps reinforce how these books function in real-world accounting. So, how do subsidiary books make our accounting work easier? Well, they streamline data entry, reduce errors, and save time. For example, instead of recording each bill in the main ledger, you record it once in the subsidiary book, which then summarizes into the main accounts. This method ensures clarity and efficiency in financial management. Now, let's briefly look at some multiple-choice questions to test our understanding of subsidiary books and related concepts. For instance, the purchases book records credit purchases, and cash purchases are recorded in the cash book. The sales book records credit sales, and the purchase returns book is also known as return outward. The sales return book is called return inward. Journal proper is primarily used for adjustment entries, not cash transactions. Notably, the trial balance is not a subsidiary book. A credit note is issued when returning goods, and a debit note is issued when returning goods to the supplier. Lastly, the bills receivable book records bills received or bills accepted. Understanding these points will help you appreciate how subsidiary books support accurate and efficient financial recording, which is the backbone of sound accounting practice. Let's go through some fundamental concepts of accounting as covered in this slide. First, the bills payable book is used specifically for recording bills that are accepted, which means when a supplier or creditor accepts a bill of exchange from us. Moving on, the discount received is typically recorded in the cash book, since it involves cash transactions. The petty cash book is maintained by the petty cashier, who handles small cash expenses on a daily basis. Next, we have contra entries, which appear in the cash book because they involve both cash and bank transactions happening simultaneously. The triple-column cash book includes 3 main columns: cash, bank, and discount, making it a comprehensive tool for recording multiple types of cash transactions in one place. When opening new accounts or recording initial entries, the book used is the journal proper, which helps in recording those preliminary or opening entries. Checks received are recorded in the cash book, as they are immediate cash equivalents. Trade discounts, which are reductions offered at the time of sale, are not recorded separately in books like the journal or ledger. Instead, they are generally reflected directly in the sales invoice. The total of the sales book is posted to the sales account, which helps keep track of the total sales made during a period. Lastly, purchase returns, which involve returning goods bought previously, reduce the purchases account, decreasing the total purchases recorded for that period. Understanding these points helps us see how various books and entries work together to maintain accurate and organized financial records. Let's now look at the basics of accounting, focusing on the trial balance. Once all business transactions have been recorded in the journal and posted to the ledger accounts, it's essential to verify whether these entries are accurate and balanced. This is where the trial balance comes into play. It is one of the most critical steps before preparing the final accounts, such as the trading account, profit and loss account, and balance sheet. The main purpose of a trial balance is to ensure that for every debit entry, there is a corresponding credit entry in accordance with the double entry system. Think of it as a checkpoint in the accounting cycle, helping us catch any mathematical mistakes or posting errors early on. It also lays a solid foundation for preparing accurate financial statements. Now, what exactly is a trial balance? It's a statement that lists all the closing balances of every ledger account, both debits and credits, on a specific date. The goal here is to verify the arithmetic accuracy of all ledger postings. In formal terms, a trial balance is prepared at the end of a particular period, usually at the close of the accounting year. It shows the debit and credit balances of all ledger accounts, serving as a tool to test whether the books are arithmetically correct. the objectives of preparing a trial balance are quite clear. First, it helps us check arithmetical accuracy by confirming that total debits equal total credits. Second, it acts as the foundational document for final accounts like the trading and profit and loss accounts, as well as the balance sheet. Third, it assists in detecting errors, whether they are posting mistakes, incorrect ledger balances, or wrong debit and credit entries. Fourth, it provides a concise financial summary of all ledger accounts, making it easier to review the overall financial position. And finally, it ensures ledger completeness, confirming that all accounts have been properly posted and balanced. In summary, the trial balance is a vital step in the accounting process, helping us maintain accuracy and integrity in our financial records and preparing us for the final financial statements. Let's take a closer look at the features of a trial balance. First, it's prepared from the balances of ledger accounts, meaning we gather the totals from the individual accounts to create this summary. It shows the debit and credit sides separately, which helps us ensure that everything is balanced and accurate. The trial balance is prepared on a specific date, usually at the end of an accounting period, to give us a snapshot of the ledger balances at that point in time. It's important to note that the trial balance does not form part of the final accounts. Instead, it acts as a preliminary step, a necessary prerequisite that helps us verify the accuracy of our ledger entries before preparing the final statements. The trial balance is prepared in a tabular format, listing account titles alongside their debit and credit amounts for clarity. Now, let's discuss the formats of preparing a trial balance. There are mainly two common formats. The first is the horizontal format, where we list the particulars and their respective debit and credit amounts side by side in a table. For example, we might have cash account on the debit side with 50,000 rupees and capital account on the credit side with 50,000 rupees, making it easy to compare. The second is the vertical format, which presents the particulars in one column, with separate columns for debit and credit amounts below. This format is often simpler and more straightforward, especially for smaller businesses or less complex accounts. It also includes a total at the bottom to verify that both sides match. Finally, there are two main types of trial balance to understand. The trial balance before adjustment is prepared before considering any year-end adjustments like depreciation or outstanding expenses. It reflects the balances as they are recorded in the ledger. The trial balance after adjustment, on the other hand, is prepared after making all necessary adjustments, providing a more accurate view of the financial position. This adjusted trial balance is often used for internal review or during audits to ensure everything is properly accounted for. Let's talk about the adjusted trial balance. This is mainly used in computerized accounting systems where the trial balance already reflects all the adjustments made, so it's ready for preparing the final accounts. Now, how do we prepare a trial balance? First, we list all the balances from the ledger accounts. Then, we classify each balance as either a debit or a credit. Once we have that, we enter these balances into the respective columns, debit and credit. The key point here is to add both columns separately and check that the total of the debit side equals the total of the credit side. This equality confirms that our books are balanced. When posting to the trial balance, certain rules apply based on the account type. Assets and expenses or losses are debits, so their balances go into the debit column. Conversely, liabilities, capital, and income or gains are credits, so their balances are entered into the credit column. Let's look at an example to make this clearer. Imagine a business with ledger balances as of March 31, 2025. For instance, cash has a balance of rupee 20,000, bank rupee 10,000, and capital rupee 50,000. Purchases are 30,000, sales rupee 45,000, rent paid rupee 5,000, salaries rupee 8,000, and furniture rupee 12,000. By listing these balances appropriately, we can prepare a trial balance that helps us verify that our books are balanced before moving on to prepare the final accounts. Let's take a closer look at the trial balance as of 31st March 2025. Here, we see a simple table listing various accounts along with their debit and credit balances. For example, cash has a balance of 20,000 rupees on the debit side, while sales are credited with 45,000 rupees. The total of debits and credits both add up to 85,000 rupees, which shows that the books are balanced at this point. Now, why is the trial balance important? Well, it helps us check the mathematical accuracy of our accounts. If the totals don't match, it indicates there might be errors that need attention. It also simplifies the process of preparing final accounts like the profit and loss statement or the balance sheet, since it summarizes all the account balances in one place. Another key point is that the trial balance makes error detection easier. If there's an imbalance, we know where to start looking for mistakes. And for auditors, the trial balance is a crucial document. They often begin their review by examining it. However, it's important to understand its limitations as well. A balanced trial balance doesn't guarantee there are no errors. Totals could still match even if some postings are incorrect or missing. For example, certain errors like compensating errors or errors of principle won't be detected through the trial balance alone. So, while it's a helpful tool, it's not foolproof. By understanding both its strengths and limitations, we can better appreciate how the trial balance fits into the overall accounting process. Let's start by understanding that the basics of accounting, as important as they are, have some limitations. First, it's crucial to realize that an accounting statement cannot fully reflect the true financial position of a business. Think of it more as a working tool rather than a complete picture. It helps us keep track of balances, but it doesn't tell the full story. Next, you'll notice that accounting records don't include details of individual transactions. They show only the balances, so we don't see the nature or specifics of each transaction behind those numbers. This means we need to dig deeper if we want to understand exactly what happened behind the scenes. Another important point is that errors in the books might not always be disclosed by the trial balance. The trial balance is a useful check, but it can sometimes hide mistakes. Let's look at some common types of errors that can occur. An error of omission happens when an entire transaction is left out of the books altogether. Imagine forgetting to record a sale or purchase. That can distort the financial picture. An error of commission occurs when the correct amount is posted, but to the wrong account of the same type. For example, recording a sale in the wrong customer's account, which can lead to inaccuracies. Then there's an error of principle, where the transaction is classified incorrectly. For instance, treating a capital expenditure as a revenue expense, which impacts how profit is calculated. Lastly, we have compensating errors, where two mistakes cancel each other out. This can make errors less obvious, but it doesn't mean the books are accurate, just that the errors offset each other. Understanding these points helps us see the limitations of accounting and the importance of careful record keeping and error detection. Let's take a closer look at this basic trial balance derived from Mr. Arjun's books as of March 31st, 2025. Here, we see some key balances that give us a snapshot of his financial position. For example, cash, which is an asset, has a balance of 20,000. Similarly, furniture, another asset, stands at rupee 10,000. On the other hand, capital, which represents the owner's equity, is credited with rupee 50,000. Now, looking at the income and expenses, sales is credited with rupee 10,000, indicating revenue earned, while purchases and salaries are debited, with rupee 25,000 and rupee 5,000 respectively, reflecting expenses. Notice how the totals at the bottom show that total debits and credits are both rupee 60,000. This is very important because it confirms that the books are balanced, which is a fundamental principle in accounting. In essence, this trial balance helps us verify that every transaction has been recorded correctly, maintaining the accounting equation's integrity. It's a vital step before preparing financial statements, ensuring everything adds up properly. Let's take a closer look at this trial balance example. Here, we see various accounts listed with their respective debit and credit amounts. For instance, the bank account shows a balance of 15,000 on the debit side, indicating an asset. Similarly, rent paid of 4,000 and purchases of rupee 18,000 are also debited, which makes sense because these are expenses or outflows. On the other side, we have capital of rupee 40,000, sales of 20,000, and commission received of 2,000 credited to their respective accounts, representing income or liabilities. Notice the totals at the bottom. Both the debit and credit sides add up to 37,000. This is a crucial point because it confirms that the trial balance is balanced, meaning there are no arithmetic errors. When the totals match, it indicates that the books are in balance, which is essential before preparing financial statements. This illustration, including bank, rent, purchases, capital, sales, and commissions, helps us understand how different types of accounts are recorded and reflected in the trial balance. Remember, debits and credits always need to balance, and this example clearly demonstrates that fundamental concept in accounting. Let's look at this trial balance example, which includes drawings and interest balances. On the debit side, we have drawings, which amount to 5,000. Drawings are debited because they reduce the owner's equity, meaning the owner is taking out money from the business. Next, wages are 6,000, and since wages are an expense, they are also debited. Cash, which is an asset, shows a balance of 9,000 and is debited as well. On the credit side, we see capital at rupee 30,000, representing the owner's investment in the business, and sales at 10,000, which is income. Interest received is rupee 2,000, and since it's income, it is credited. Now, note that the total of the debits and credits both come to rupee 20,000, which confirms that the trial balance balances. This balance is essential because it shows that our books are in equilibrium and all transactions have been recorded correctly. So the key points here are understanding why certain accounts are debited or credited. Expenses and assets are debited. Income and owner's equity are credited. And recognizing the importance of balancing the trial balance to ensure accurate accounting records. Let's look at this example of a trial balance that includes debtors' and creditors' balances. Here, the debtors amount to rupee 18,000, which represent amounts owed to us by our customers. The creditors are 12,000, which are the amounts we owe to suppliers. Moving to assets, we have furniture valued at rupee 10,000 and purchases of rupee 20,000, which are considered expenses or assets depending on their nature. In our trial balance, you'll notice that the debits include debtors, furniture, and purchases because these are assets or expenses. On the other hand, creditors are liabilities, so they are listed on the credit side. Similarly, sales and capital are also credited, reflecting the income and owner's investment in the business. An important point here is that all these balances are properly grouped under the debit and credit columns. The total of the debits and credits matches perfectly at rupee 48,000. This equality confirms that our books are balanced, which is a fundamental principle in accounting. So, the key takeaway is that a trial balance helps us ensure that our accounting entries are accurate and balanced, giving us a clear snapshot of our financial position at a glance. Now, let's look at this illustration of a trial balance that includes outstanding rent balances. As you can see, the trial balance lists various accounts along with their debit and credit amounts. For example, cash is rupee 8,000, and capital is rupee 25,000. Notice the rent account shows rupee 3,000, which is the total rent expense, but there's also a specific entry for rent outstanding, which is rupee 1,000. This outstanding rent is a liability because it hasn't been paid yet. That's why in the trial balance, rent outstanding is credited, reflecting that it's a liability owed. On the other side, we have assets and expenses like cash, rent paid, and purchases, which are debited because they involve outflows or resources owned by the business. Conversely, capital and sales are incomes, money earned or invested, so they are credited. The total of debits and credits here both come to rupee 23,000, maintaining the fundamental accounting equation. This illustration is important because it introduces the concept of adjustments, like outstanding expenses, that need to be accounted for properly in final accounts. Recognizing outstanding rent as a liability ensures we reflect the true financial position of the business. So, understanding these adjustments helps us prepare more accurate financial statements, which is the core goal in accounting. Let's look at this illustration of a trial balance that includes loan balances. On the debit side, we have cash amounting to 12,000, interest paid of 2,000, and furniture valued at rupee 6,000. These are assets and expenses, so they are debited. On the credit side, we see capital at 30,000, which represents the owner's contribution, and bank loan of 10,000, which is a liability. Notice that the total debits and credits both add up to 20,000, which confirms that the books are balanced. An important point here is understanding why certain accounts are credited or debited. For example, cash, interest paid, and furniture are debited because they increase assets or expenses. Conversely, capital is credited because it reflects the owner's contribution, an increase in equity. Now, looking at the bank loan, it's credited because it's a liability, money borrowed that the business owes. This loan increases the liabilities on the balance sheet. Overall, what this illustration shows us is how borrowed money, like the bank loan, increases liabilities, and how interest paid reduces profit, since it's an expense. This balance sheet picture helps us see the financial position clearly, especially how liabilities like loans impact the overall financial structure. It ties into the broader theme of understanding how different transactions affect the books and the importance of maintaining this balance. Let's take a closer look at this trial balance example, which includes some insurance balances. As you can see, we have various accounts listed with their respective debit and credit amounts. For instance, cash is recorded as 10,000 on the debit side, and insurance premium is 1,000, also on the debit side. On the credit side, we have capital at rupee 20,000, sales at rupee 8,000, and rent received at rupee 3,000. The total debits and credits both amount to 11,000, which indicates that our books are balanced. Now, it's important to understand how certain accounts are treated here. Cash and insurance premium are debited because they are assets and prepaid expenses, respectively. When we pay an insurance premium in advance, it's considered a prepaid expense. That's why it appears as a debit. On the other hand, accounts like capital, sales, and rent received are credited. Capital represents the owner's equity, sales reflect income from selling goods or services, and rent received is another form of income. This example highlights how an insurance premium, although an expense when incurred, is initially recorded as a debit because it's a prepaid expense. And rent received is shown as income, credited to reflect that it's earning for the business. Overall, this trial balance illustrates the basic accounting principles of debits and credits, and how different types of accounts are treated in the books. It reinforces the idea that understanding these classifications helps us keep accurate and balanced financial records. Let's look at this example of a trial balance with outstanding salary balances. As you can see, we have several accounts listed here. Salaries are recorded at rupee 5,000, which represents the expense incurred during the period. Cash is at rupee 6,000, showing the liquid asset available. Outstanding salaries, which are liabilities, are at rupee 2,000. This indicates salaries that have been incurred but not yet paid. Capital is at rupee 10,000, representing the owner's equity, and sales amount to rupee 7,000, reflecting the revenue earned. Now, in the trial balance chart, notice how the accounts are categorized into debits and credits. Salaries and cash are on the debit side, which makes sense because salaries are expenses and cash is an asset, both typically debit balances. Outstanding salaries, capital, and sales are on the credit side, aligning with their nature as liabilities, owner's equity, and revenue, respectively. This example emphasizes an important concept. It's a year-end adjustment. Even if the salaries haven't been paid yet, we recognize the expense in the books. That's why outstanding salaries appear as a liability. It's an obligation that we need to settle later. Recognizing such outstanding balances ensures our financial statements accurately reflect the true financial position at year-end. So, the key takeaway here is that adjustments like these are crucial for matching expenses and revenues to the correct period, maintaining the accuracy of our financial reporting. Let's look at this illustration of a trial balance with opening stock balances. Here, we see the opening stock valued at rupee 12,000, along with cash of rupee 7,000, capital of 20,000, purchases amounting to 10,000, and sales of 9,000. Now, the trial balance itself lists these particulars with their respective debit and credit amounts. In the trial balance, you'll notice that the opening stock, cash, and purchases are shown on the debit side. This is because they are considered either assets or expenses, assets like cash and stock, and expenses like purchases. On the other hand, capital and sales are on the credit side, representing the owner's capital and the revenue generated from sales. It's important to remember that opening stock is a nominal account, and it appears on the debit side in the trading account. This is because it forms part of the cost of goods sold and is essential for calculating gross profit. When we prepare the trial balance, the total of debits and credits should always match, as we see here with rupee 29,000 on both sides. Connecting this to the overall theme, understanding how opening stock and other balances are recorded helps us ensure accurate financial statements and proper recording of business transactions. This is fundamental to the basics of accounting, giving us a clear picture of the financial position at the start of a period. Let's take a closer look at this trial balance example, which includes fixed assets like machinery and furniture, along with cash, capital, and sales. As you can see, the machinery is valued at rupee 20,000, furniture at rupee 10,000, and cash at rupee 5,000. These are all assets, so they appear on the debit side of the trial balance. On the other hand, capital and sales are credited, with values of 30,000 and rupee 5,000 respectively. The purpose of this illustration is to show how investments in fixed assets and income from sales are recorded in the same period. Now notice the totals, both sides balance at rupee 35,000, confirming the fundamental accounting principle that total debits equal total credits. This balance helps us verify that our books are mathematically correct. Moving on, the trial balance is an essential tool in the accounting cycle. It acts as a bridge between the ledger accounts and the final accounts. While it doesn't guarantee complete accuracy, it's a vital checkpoint to catch major posting errors and ensure the numbers add up correctly. Accountants, students, and auditors all rely on trial balances because they provide a systematic foundation for financial reporting. Understanding how to prepare and interpret a trial balance not only strengthens your accounting skills, but also boosts confidence in producing accurate financial statements. In summary, mastering the trial balance is crucial for anyone involved in accounting, as it ensures reliability in financial data and helps maintain the integrity of the reporting process. Let's explore some important concepts related to the basics of accounting, specifically focusing on the trial balance. First, what exactly is a trial balance? It's a statement that lists all the ledger balances of a business at a particular point in time. Its main purpose is to check the arithmetical accuracy of the books and ensure that total debits equal total credits. Now, why do we prepare a trial balance? Well, it helps identify errors in the ledger, acts as a stepping stone toward preparing financial statements, and provides a quick snapshot of the company's financial position. There are several methods of preparing a trial balance. Two common ones are the total method and the balancing method. The total method involves summing all the debit and credit columns separately, while the balancing method involves calculating the difference between debits and credits to find the balance. Understanding the terms debit and credit balance is crucial. A debit balance appears on the assets side, while a credit balance appears on liabilities or capital accounts. Interestingly, some errors don't affect the trial balance at all. For example, errors of omission or errors of commission, where entries are recorded in the wrong accounts but with the correct amounts, usually don't disturb the balance. However, the trial balance isn't perfect. It has limitations. It can't detect errors like omissions, errors of duplication, or compensating errors, which can still leave the trial balance in agreement. One method used in preparing a trial balance is the total method, where totals are listed, and the balance is derived from those. The balancing method, by contrast, focuses on balancing the accounts to find the net balances. Now, what are the advantages of preparing a trial balance? It helps in error detection, simplifies the preparation of financial statements, and provides a clear view of the ledger balances. Conversely, its limitations include not catching all errors and sometimes giving a false sense of accuracy. Distinguishing between a trial balance and a balance sheet is also important. The trial balance is a summary of ledger balances, while the balance sheet is a formal financial statement showing assets, liabilities, and equity at a specific date. Let's consider an example to see how a trial balance is prepared. Suppose we have balances like capital of 50,000 rupees, cash of 10,000, sales of 35,000, purchases of 15,000, and wages of 5,000. Using the total method, we sum all these balances to prepare the trial balance. Additionally, a trial balance is helpful in detecting errors, but it has its limitations. For instance, it won't reveal errors like recording a transaction twice or reviewing the debit and credit entries. Common errors that do not affect the trial balance include errors of omission, errors of commission, and errors of principal. In summary, the trial balance is a vital tool in accounting, acting as a preliminary check to ensure the books are balanced and correct. It's essential for maintaining accurate financial records and supporting the overall integrity of financial reporting. Let's dive into the basics of accounting, specifically focusing on Part C, which covers 10 marks questions. First, we'll define what a trial balance is. A trial balance is a statement that lists all the ledger account balances at a particular point in time, usually at the end of an accounting period. Its main objectives are to check the arithmetical accuracy of ledger postings and to prepare the final accounts easily. When we talk about methods of preparing a trial balance, the most common approach is the total method and the balance method. The total method involves listing the total debits and credits for each account, while the balance method lists only the net balances of each account. The format can vary, but generally, it includes columns for account titles, debit balances, and credit balances. Now, to illustrate this, let's consider some balances. Cash rupee 8,000, capital rupee 50,000, machinery rupee 25,000, purchases 12,000, sales rupee 18,000, salaries 2,000, rent rupee 1,500, furniture rupee 6,000, creditors 10,000. Using these, we can prepare a trial balance as of 31st March, making sure the total debits equal total credits. Moving on, it's crucial to understand the different types of errors in accounting. Some errors, like a wrong amount posted or a mistake in a ledger entry, affect the trial balance, causing it not to tally. However, some errors, such as omission of a transaction or incorrect classification, may not affect the trial balance at all. Recognizing these errors helps us ensure our accounts are accurate. The statement, "trial balance is the stepping stone to preparing final accounts," is very true. It acts as a checkpoint before finalizing the accounts, helping us identify errors early and ensuring our figures are accurate for the income statement and balance sheet. The trial balance plays a vital role in the accounting cycle. It helps in summarizing all ledger balances, facilitates the preparation of financial statements, and acts as a tool for error detection. If the trial balance doesn't tally, it indicates errors that need investigation, such as transposition errors or incorrect postings. Some errors are disclosed by the trial balance, like arithmetic mistakes or double posting errors. Others, like omission or compensating errors, remain hidden unless further checks are performed. For example, if a transaction is completely omitted, the trial balance may still tally, so we need additional methods to detect such errors. When preparing a trial balance, there are two methods to consider: the total method and the balance method. The total method lists total debits and credits, while the balance method lists only the net balances of each account. Both serve to verify the accuracy of ledger postings, but the choice depends on the specific need. Disagreements in trial balance can occur due to various causes such as errors in addition, incorrect postings, or transpositions. To resolve these, we carefully check the arithmetic, review ledger entries, and look for discrepancies. Finally, when the trial balance doesn't tally, we prepare a sample trial balance and then trace the errors systematically. For example, we check each ledger entry, verify totals, and look for transpositions or duplications. This process helps us locate and correct errors, ensuring our accounts are accurate and reliable. That covers the key points of trial balance basics, methods, errors, and troubleshooting, integral steps in maintaining accurate financial records. Let's go through some key points about the basics of accounting, focusing on trial balance questions. First, trial balance is prepared at the end of the accounting period, typically at year-end, to ensure that all ledger balances are correctly recorded and balanced. It's not prepared daily, monthly, or quarterly, but specifically at the year-end. Second, a trial balance is a statement. It's essentially a statement that lists all ledger balances. It's not a ledger, a book, or a journal, but a statement summarizing balances. Third, in the trial balance, you will see the balances of real accounts and nominal accounts, but not drawing accounts or closing stock. The drawing account is a personal account, but not shown in the trial balance, and closing stock is an asset, which is shown separately in the financial statements. Next, the capital account usually shows on the credit side. This is because capital is a liability to the business. It represents owner's investment. Then, certain accounts, like wages or interest received, show only debit balances. For example, wages is an expense, which normally has a debit balance, whereas capital accounts usually have credit balances. Now, when errors occur that affect the trial balance, they can be of different types, like omission errors, which are quite common, or compensating errors, which offset each other. Errors of omission are especially impactful because they can lead to discrepancies. A suspense account is created when the trial balance doesn't tally. That is, the totals don't match. It's a temporary account to hold the difference until the error is found and corrected. Regarding totals, the trial balance totals must agree, meaning the total debits should equal total credits. If they don't, there is an error that needs to be investigated. A credit balance in an account often indicates a liability, income, or sometimes a gain, while a debit balance generally indicates an asset or expense. The trial balance is very useful in preparing the financial statements, especially the profit and loss account and the balance sheet. It helps ensure that all ledger balances are correctly compiled and ready for financial reporting. Finally, the trial balance is prepared from ledger balances, not directly from the journal or cash book. Typically, accounts like rent or wages usually have debit balances, since they are expenses. Accounts like sales, on the other hand, usually have credit balances as they are income. I hope this overview clarifies some of the fundamental concepts behind trial balance and its role in the accounting process. Let's go through some key points from slide 84. First, question 13 asks which item appears on the credit side of the trial balance. The correct answer is B, commission received. This is because income or revenue accounts, like commissions, typically have a credit balance. Next, question 14 focuses on what the trial balance checks. The correct answer is B, accuracy of postings. The trial balance helps us verify whether all ledger entries have been correctly posted, ensuring the debits and credits are balanced. Moving on, question 15 discusses what it means if the trial balance agrees. The answer is C, still may contain errors. It's important to remember that a balanced trial balance does not guarantee that there are no errors. It just indicates that the total debits and credits match. Question 16 asks about an expense wrongly posted to income. The correct answer is C, principal error. This kind of mistake violates accounting principles because expenses and incomes are separate categories. In question 17, we see when a suspense account appears. The answer is C, difference in trial balance. Suspense accounts are used temporarily to account for discrepancies until errors are identified and corrected. Question 18 states that if the total of the trial balance is rupee 80,000, it means C, errors may still exist. A balanced trial balance suggests that debits and credits match, but errors can still be present. Question 19 asks about an error affecting both sides equally. The correct answer is C, compensating error. These errors offset each other, so the trial balance still balances despite mistakes. Finally, question 20 explains that the trial balance provides D, list of creditors. However, more accurately, it is a summary of all ledger accounts, showing balances to help prepare final accounts. Overall, the trial balance is a crucial step in the accounting process. It helps verify accuracy, but doesn't guarantee the absence of all errors. Keep this in mind as we move forward in understanding financial statements. In this slide, we are discussing the basics of accounting, specifically focusing on the rectification of errors. Now, in accounting, an error refers to a mistake made during recording, posting, or summarizing financial transactions. Even if the trial balance shows that both sides are equal, it doesn't necessarily mean that the books are error-free. Errors can happen due to human mistakes, misunderstandings of accounting principles, or technical failures, especially in computerized systems. It's important to identify and correct these errors promptly to ensure our financial statements are accurate and fairly represent the business's financial position. Some errors are intentional, while others are unintentional, and they may or may not affect the trial balances agreement. Understanding the different types of errors helps us to identify and fix them more efficiently. Now let's look at how errors are classified. Broadly, we divide them into two categories: errors that are not disclosed by the trial balance and those that are disclosed. Starting with errors not disclosed by the trial balance, these are errors that do not disturb the balance of the books. Both the debit and credit sides are affected equally, so the trial balance still tallies. However, it's crucial to remember that the financial results and the overall position might still be misstated, which can be misleading. One common type of error in this category is errors of omission. These occur when a transaction is either completely or partially left out of the books. For example, if we purchase goods worth rupee 5,000 on credit from Mr. X but forget to record this transaction at all, that's a complete omission. Conversely, if the purchase is recorded in the journal but not posted to the ledger, that's a partial omission. These errors might seem minor, but they can have significant implications for our financial accuracy. Recognizing and correcting them is essential for maintaining reliable financial records. On this slide, we're looking at some common errors in accounting and their impact on the trial balance. First, even if there are errors of commission or principal, the trial balance may still tally because the total debits and credits can remain equal, especially in certain cases. Now, errors of commission happen when there's a mistake in recording, posting, or calculation, but the correct amount is entered. For example, if you enter the correct amount in the wrong personal account or post to the wrong side of an account, that's an error of commission. An illustration of this would be receiving money from Mr. Ramesh, but accidentally posting it to Mr. Raj's account. The impact. The trial balance may or may not tally, depending on the nature of the mistake. Sometimes it balances, sometimes it doesn't. Next, errors of principle occur when transactions are recorded in violation of basic accounting principles. This usually happens due to a lack of understanding or knowledge. For instance, if you buy machinery worth 50,000 rupees but mistakenly debit the purchase's account instead of the machinery account, that's an error of principle. The key point here is that, even though the trial balance will still tally, the financial statements will be incorrect because the classification is wrong. Finally, we have compensating errors. These are errors that cancel each other out. For example, if rent is understated by 500 rupees and sales are overstated by the same amount, the net effect on the trial balance is zero. both sides are off by the same amount, so the trial balance will still tally. The challenge with these errors is that they are harder to detect because the overall balance looks correct, even though the details are flawed. So, in summary, while the trial balance might still tally despite these errors, it doesn't mean everything is correct. That's why understanding these errors is crucial for accurate financial reporting. Now, let's look at some common errors that can be revealed by the trial balance. These errors typically cause a disagreement or imbalance in the trial balance, and they often stem from mistakes in arithmetic or posting. One type of error is errors in casting, also known as totaling errors. This happens when there's a mistake made while totaling the subsidiary books, like the sales book or purchases book. For example, if the sales book is undercast by 2,000 rupees, that means the total recorded is less than it should be. The impact of this is that the sales figure posted to the ledger will be incorrect, which then causes a mismatch in the trial balance. Another common error involves mistakes in posting. These occur during the transfer process from the journal to the ledger. For instance, a wrong amount might be posted, say, 1,200 rupees instead of 2,100 rupees. Or the posting could be made to the wrong side, like debiting instead of crediting. Sometimes, the amount is posted to the wrong account altogether. Since these errors usually affect only one side of the trial balance, they cause the balances not to tally, but they might not be immediately obvious. Then, there are errors in carrying forward balances. This happens when balances are incorrectly transferred from one page of the ledger to another or from the books of prime entry. For example, a balance carried forward might be 4,500 rupees instead of 5,400 rupees. Such mistakes lead to discrepancies, and the trial balance will not agree because the balances are not accurately reflected. Finally, errors in balancing accounts occur when wrong balances are taken after closing the ledger accounts. For instance, a debtor's account might be closed with a balance of 10,000 rupees instead of 11,000 rupees. These errors affect the final balances and, consequently, cause the trial balance to be unbalanced. Understanding these common errors helps us identify and correct discrepancies, ensuring our financial records are accurate and reliable. Let's now look at the impact of errors in accounting. When an incorrect balance is taken into the trial balance, it can cause disagreements and discrepancies that affect the accuracy of the financial statements. Moving on, to make learning easier and more effective, errors are often classified based on their nature and effect. For example, errors can be categorized into types like errors of omission, commission, or principles. These classifications help us understand what kind of mistake has occurred and how it impacts the trial balance. It's important to note that some errors are disclosed by the trial balance, while others are not. Also, errors can happen at different stages, during the journal entry, posting to the ledger, totaling, or balancing. In summary, classifying errors helps accountants identify the nature and cause of discrepancies, which is crucial for detecting, rectifying, and preventing mistakes. Even if the trial balance tallies, errors might still exist, especially those related to principles, omissions, or compensating errors. That's why periodic audits and reconciliations are essential. Once errors are found, they must be corrected systematically through proper journal entries to ensure that the books reflect the true financial position of the business. Now, let's briefly discuss the rectification of errors. Despite careful recording, errors can still occur at any stage while recording, posting, or balancing transactions. These mistakes can lead to inaccurate financial statements and potentially misleading business decisions. So, the process of correcting these mistakes is known as rectification of errors. What does rectification mean? It's simply the process of correcting errors in the accounting records. When we discover an error, we pass a proper journal entry to reverse or adjust the incorrect entry, and then record the correct one. In essence, rectification involves correcting errors in the original books of entry or ledger, so that the financial statements accurately reflect the true financial position of the business. Now, let's talk about when errors are rectified in accounting. The timing really depends on when the error is discovered. If you find an error before preparing the trial balance, it's usually straightforward to correct. You can make a simple correction directly in the relevant books or ledger, and there's no need to pass journal entries for that. However, if the error is found after the trial balance has been prepared, but before final accounts are made, then you need to use journal entries to correct the mistake. Sometimes, if the trial balance doesn't tally, a suspense account can be used temporarily to keep the books balanced while you identify and fix the error. Once the final accounts are prepared, rectifications are made in the next accounting period. These are usually adjustments through a profit and loss adjustment account or prior period adjustments. Now let's focus on the process itself. How you rectify an error depends on the nature of that error, whether it's an omission, commission, or a breach of principles. It also depends on whether the error affects the trial balance or not, and whether it's a one-sided or a two-sided error. Talking about one-sided errors, these only impact a single account and cause a difference in the trial balance. For example, if sales are undercast by 1,000, you would correct this by making an entry in the suspense account. Debit suspense account and credit sales account with 1,000. On the other hand, two-sided errors involve two or more accounts. These might not affect the trial balance if the debit and credit sides are equal. For instance, if wages of 2,000 are wrongly debited to machinery account, it's a two-sided error. Correcting this will involve adjusting both accounts accordingly, but the trial balance might still tally if the mistake was balanced on both sides. Understanding these distinctions helps us ensure our books are accurate and reliable. Let's now look at the entry for rectification. When an error is identified, we make a correcting entry. For example, if wages were paid but not recorded properly, we would debit wages AC with 2,000 and credit machinery AC with 2,000. Moving on to the methods of rectifying errors, the first is rectification by direct correction, which is done before the trial balance. Here, we simply correct the original entry without passing a new journal. For instance, if cash sales of 5,000 were not recorded, we just pass the normal entry. Debit cash AC with 5,000 and credit sales AC with rupee 5,000. The second method is rectification through journal entries, which is used after the trial balance. In this case, we pass a correcting journal entry to nullify the effect of the error. For example, if repairs of 3,000 were wrongly debited to furniture AC, the wrong entry would be furniture AC Dr. rupee 3,000 and to cash AC 3,000. To rectify it, we debit repairs AC with 3,000 and credit furniture AC with 3,000. Finally, we have rectification using a suspense account. When the trial balance does not tally, we open a suspense account temporarily. This helps us locate and correct the error. For example, if rupee 1,500 paid to a creditor was not posted to the creditor's account, we would debit creditors AC with 1,500 and credit suspense AC with rupee 1,500. This process helps ensure the books are balanced while the error is being traced and corrected. Let's take a closer look at some examples of rectification entries. These are necessary when errors occur in recording transactions, and correcting them ensures our financial records are accurate. For instance, if we purchase machinery worth rupee 10,000 but mistakenly recorded in the purchases account instead of machinery, we need to make a rectification entry. This would be a debit to machinery account and a credit to purchases account, both for 10,000. Another common mistake involves wages. Suppose we posted wages of 1,000 to salaries instead of wages. We correct this by debiting wages and crediting salaries for 1,000. Similarly, if sales of 2,000 are not posted at all, perhaps because they were overlooked, we record a debit to debtors account and a credit to sales account for 2,000. Now, why is rectification so important? First, it ensures the accuracy of our financial statements. Accurate records prevent misleading information, which is crucial for decision-making. It also helps us stay compliant with accounting principles and standards. Furthermore, proper rectification makes audits smoother and enhances internal controls. It also aids in detecting fraud or manipulations in the books, which is vital for maintaining integrity. Let's look at specific examples. In illustration 31, we see an error of omission where goods worth rupee 5,000 purchased from Mr. Arrol were completely left out of the books. To rectify this, we debit purchases and credit Mr. Arrol's account, recording the purchase properly now. In illustration 32, there was an error of commission. Rupee 3,000 received from Mr. Raja was mistakenly credited to Mr. Raju's account. To correct this, we debit Mr. Raja's account and credit Mr. Raju's, ensuring the correct person is credited. These examples highlight how precise rectification entries help us maintain accurate and trustworthy financial records. Let's go through some common accounting errors and how to correct them. First, consider the error of principle. For example, if rupee 10,000 spent on purchasing a motor vehicle was incorrectly debited to repairs account, which is an expense account, that's a mistake. Since this is a capital expenditure, it should have been debited to the motor vehicle account. The rectification entry involves debiting motor vehicle account and crediting repairs account with rupee 10,000 to correct this. Next, we have the compensating error. Imagine the sales book was undercast by rupee 500, meaning sales were understated, and at the same time, wages were overcast by rupee 500. These errors cancel each other out in the books, so technically, no rectification entry is needed. However, it's important to correct each error in its respective book to maintain accuracy. Moving on to one-sided errors, suppose rupee 1,200 paid to Mr. Manny was posted as rupee 120 in his account. That's a significant underposting. To fix this, we create a rectification entry debiting Mr. Manny's account for the difference of 1,080 and crediting suspense account for the same amount. This clears up the mistake and aligns the accounts correctly. Finally, errors in posting to the wrong side happen when, for example, rupee 2,000 received from Mr. Kumar was wrongly credited to his account instead of debiting it. To rectify this, we need to adjust both the cash account and Mr. Kumar's account, along with the suspense account if necessary. The correction involves debiting Mr. Kumar's account and crediting cash and suspense accounts appropriately. Understanding these errors and their corrections is crucial because they ensure our financial statements are accurate and reliable. Each type of error has a specific correction method, and recognizing them helps us maintain integrity in accounting records. Now, let's look at some common accounting errors and how we can rectify them. In this example, a personal expense of $2,500 spent on a proprietor's personal trip was mistakenly recorded as a business expense under traveling expenses. To correct this, we make a journal entry debiting drawings AC and crediting traveling expenses. AC this ensures the personal expense is properly separated from business expenses. Moving on, suppose there's an overstatement in the purchase book by 1,000. This is an error in the subsidiary books, and to fix it, we create a suspense account debit and a credit to the purchases. AC this rectification clears the overcast, and our books now reflect the correct purchase total. Next, consider an error during journalizing. If goods returned to Mr. Ramesh worth rupee 750 were wrongly debited to his account instead of being credited, we need to rectify this. We do so by debiting Mr. Ramesh's account with rupee 1,500 and crediting both purchase returns and suspense accounts with 750 each. This correction properly records the return and adjusts the error. Finally, there's a case where a receipt of 1,000 was recorded in the journal, but not posted to Mr. Dinesh's ledger account. To rectify this, we debit Mr. Dinesh's account and credit suspense AC, ensuring the receipt is correctly reflected in his ledger. These examples highlight how errors can occur at different stages and the importance of proper rectification entries to keep our books accurate. Let's talk about the basics of accounting, focusing on the importance of rectifying errors. Correcting errors is a vital part of maintaining accurate financial records. It helps ensure that our financial statements are reliable and truly reflect the business's financial position. As accountants, it's crucial that we understand the different types of errors that can occur. Once we identify an error, we need to rectify it systematically, using the appropriate accounting entries. Whether the mistake affects just one account or two accounts, addressing it promptly is essential. Making these corrections helps us present a true and fair view of the business at all times. This process isn't just about fixing numbers. It's about preserving the integrity and transparency of our financial reporting. So, understanding how to properly rectify errors is fundamental to good accounting practice and overall financial stewardship. Let's talk about the suspense account, which is a very important concept in accounting. A suspense account is essentially a temporary account used when there's a discrepancy in the trial balance that we can't immediately resolve. Imagine you're balancing the books and find that the totals don't match. Instead of delaying the process, you put the difference into this suspense account. It acts as a holding place, allowing you to keep the books balanced temporarily until you identify and correct the error. This account is crucial because it helps maintain the integrity and flow of the accounting process, especially when you're working under tight deadlines for final accounts. Now, the key idea here is that the suspense account is temporary. It records differences, especially when there's a one-sided error, so that you can proceed with preparing financial statements even if you haven't yet pinpointed the exact mistake. To clarify, a suspense account is used mainly when the trial balance doesn't agree and you haven't found the error yet. It also comes into play when transactions are incomplete or unclear, for example, if the payee or the amount is missing. Sometimes, a transaction needs to be temporarily classified until further details are available, and that's when the suspense account comes to the rescue. Now, regarding its nature, if the trial balance shows a shortfall on the debit side, the difference is debited to the suspense account. This way, the books stay balanced, and you can focus on resolving the discrepancy later. Overall, the suspense account is a useful tool to keep the accounting process smooth and organized, especially when dealing with uncertainties or errors that need investigation. Now, let's talk about what happens if the credit side of the trial balance is short. In such cases, the difference is credited to the suspense account. Think of the suspense account as a temporary holding place for errors that need fixing. Once all errors are identified and corrected, and the balances are properly posted to their respective accounts, the suspense account is closed. In terms of treatment in the books, if the debit total is less than the credit total, we make a journal entry debiting the suspense account and crediting the difference. Conversely, if the credit total is less than the debit total, we debit the difference directly to the suspense account. After errors are discovered, we pass rectifying entries, which adjust the suspense account accordingly. Now, it's important to understand what types of errors require the use of a suspense account. Mostly, we deal with one-sided errors, like underposting or overposting in a ledger, omission to post, posting to the wrong side, or incorrect totaling. These kinds of errors create discrepancies that need temporary correction through the suspense account. On the other hand, two-sided errors that affect two accounts equally do not impact the trial balance, so they don't require the suspense account. Finally, let's go through the step-by-step process of preparing a suspense account. It starts with preparing the trial balance by adding up all the ledger totals on both sides, then identifying any difference if present. This difference is what we need to correct using the suspense account. This process helps us maintain accurate financial records and ensure our trial balance is balanced. Now let's move on to step 2, opening a suspense account. If we find that the debit side is less than the credit side, we record the difference on the debit side of the suspense account. Conversely, if the credit side is less, we record the difference on the credit side. Remember, this is just a temporary measure, a balancing figure, that helps us prepare the final accounts smoothly. Next, in step 3, we need to identify errors. This involves reviewing transactions, ledger postings, and subsidiary books carefully. Our goal here is to locate any one-sided errors, that is, mistakes where only one side was affected, that caused the trial balance to be off. Once we spot these errors, step 4 is to pass rectification entries. We record journal entries to correct those errors and then post them to the respective ledger accounts, including the suspense account. In Step 5, we prepare the suspense account ledger. This means posting all the correcting entries that impact the suspense account. The key is that after all these corrections, the suspense account should balance out, ideally showing a zero balance. For example, imagine our trial balance shows a difference of rupee 3,000, with the debit side being less. We open a suspense account and debit it by rupee 3,000 to balance the trial balance. Now errors can be discovered later. For instance, wages paid of 1,200 were not posted to the wages account. That's a typical one-sided error, missing on the debit side. To correct this, we pass a journal entry, debit wages account and credit the suspense account with 1,200. Similarly, if rupee 800 received from Mr. Ram was not posted to his account, that's another one-sided error, this time missing on the credit side. We correct it with a journal entry, credit Mr. Ram's account and debit the suspense account. In summary, handling errors and balancing differences through the suspense account is a crucial part of maintaining accurate books. It helps us identify discrepancies, correct them systematically, and ensure our final accounts are correct and balanced. Let's now look at some key concepts related to the suspense account. First, when we record a journal entry like this, where we debit suspense AC and credit RAM AC with rupee 800, it indicates that there's some uncertainty about the correct account. Next, consider the example of the sales book being undercast by 1,000. This is a one-sided error, specifically a shortfall on the credit side of the sales AC. To correct this, we record a journal entry debiting suspense AC and crediting sales AC with 1,000. This helps us temporarily hold the error in suspense until we can identify and rectify it properly. Now, looking at the suspense account ledger, we see that it starts with an opening balance of rupee 3,000, which is carried forward from previous entries. On January 1, there are entries to sales AC and wages AC, and the total debits and credits are balanced at 2,000 and rupee 3,000 respectively. Because of these errors, the balance on the suspense side is 1,000 debit, which indicates a discrepancy. The goal is that after all errors are identified and corrected, the suspense account will show no balance, meaning it's been cleared. Once we adjust all entries properly, the suspense account gets fully cleared, and the trial balance will then tally perfectly. This is essential because it ensures our financial statements are accurate. Using a suspense account offers several advantages. It allows us to prepare financial statements on time, even when some errors are yet to be identified. It also helps us detect and rectify errors systematically, maintaining the overall integrity of our accounting process, even when some mistakes exist temporarily. So, in summary, the suspense account acts as a temporary holding place for errors, helping us keep our books balanced while we work on fixing those errors to ensure accurate financial reporting. Let's now look at the basics of accounting and the role of the suspense account. It helps keep our records systematic and organized, acting as a temporary buffer when we don't have all the details at hand. However, it's important to remember that the suspense account is not a substitute for proper accounting. It should not be used repeatedly or as a habit because doing so can lead to problems. Errors need to be identified and corrected quickly to maintain accuracy. Leaving balances in the suspense account can reflect poor internal control and might hide real discrepancies if we're not careful. For example, in illustration 41, wages of 2,000 were paid but not posted to the wages account. This mistake was rectified by debiting the wages account and crediting the suspense account. Similarly, in illustration 42, rupee 1,500 received from Mr. Errol wasn't posted to his ledger account. Correcting this involved debiting the suspense account and crediting Errol's account. Lastly, in illustration 43, the sales book was undercast by 3,000, and the correction involved debiting the suspense account and crediting the sales account. These examples highlight how the suspense account helps temporarily hold errors until they can be properly corrected. But they also remind us that such issues should be resolved promptly to ensure our records are accurate and reliable. Let's look at some common accounting errors and how we rectify them. In illustration 44, we see that a discount of rupee 200 allowed to a customer was not posted to the discount allowed account. This oversight can affect our financial statements, so we make a rectification entry by debiting the discount allowed account and crediting suspense. This corrects the error and ensures our ledger reflects the true discount allowed. Moving on to illustration 45, a purchase return of 1,000 was not posted to the supplier's account. This means our creditor's account isn't accurate. To fix this, we debit suspense and credit the creditor's account, properly recording the return. This step is crucial for maintaining correct creditor balances. In illustration 46, we see that rent of rupee 500 was paid and entered in the cash book, but not posted to the rent account. This omission can distort our expenses. The rectification involves debiting rent and crediting suspense, ensuring the rent expense is accurately recorded in the ledger. Next, illustration 47 highlights that a discount received of rupee 300 was not posted to the discount received account. Omissions like this can misstate our income. To rectify, we debit suspense and credit discount received, properly recording the income. Finally, in illustration 48, a carriage inward of rupee 700 paid was omitted from the carriage inward account. Since carriage inward is part of our cost of goods, failing to post it affects cost calculations. The correction is to debit carriage inward and credit suspense, ensuring this expense is properly included. Overall, these examples emphasize the importance of diligent posting and the use of suspense accounts to temporarily hold errors until corrected. Consistent accuracy in recording transactions is key to reliable financial reporting. Let's look at some common rectification entries that we might encounter in accounting. First, consider the carriage inward account. If the carriage inward cost of rupee 700 was not posted to the ledger, we make a rectification entry by debiting the carriage inward AC and crediting the suspense AC with rupee 700. This ensures that the expense is correctly recorded and the error is now rectified. Next, suppose we received a commission of rupee 200, but it was not posted to the commission AC to correct this. We debit the suspense AC and credit the commission AC with 1,200. This adjustment properly reflects the income that was omitted initially. Another example involves the purchases book. If it was overcast by rupee 2,000, meaning the total was inflated, we make a rectification by debiting the purchase AC and crediting the suspense AC with 2,000. This corrects the overstatement and brings the accounts back in balance. Now, let's step back and understand the bigger picture. The suspense account plays a crucial role. It acts as a temporary holding account for discrepancies or errors in our trial balance until we locate and fix these mistakes. While it's very useful for keeping our accounts moving forward without delays, we must use it responsibly. Our ultimate aim is to identify all errors, so the suspense account finally shows a zero balance, ensuring our financial statements truly reflect the business's real position. To wrap up, understanding these rectification entries helps us maintain accurate and reliable accounts, which is vital for sound financial decision-making. Let's now look at some fundamental concepts in accounting, starting with errors of commission. An error of commission occurs when a mistake is made in recording or posting transactions, but it doesn't necessarily affect the overall trial balance. For example, recording an invoice for 500 instead of 5,000 or posting a payment to the wrong customer's account are typical errors of commission. These mistakes are important to identify because they can lead to inaccuracies in individual accounts, even though the trial balance may still balance. Next, we should understand errors that do not affect the trial balance. Two common examples are errors of omission and errors of commission that are not posted correctly, but still keep the trial balance in balance. For instance, if a sale is made but not recorded at all, or if a purchase is recorded in the wrong account but the total debits and credits remain equal, the trial balance will still match. Moving on, what is an error of principal? This happens when a transaction is recorded in the wrong account type, say, treating a capital expenditure as a revenue expense. These errors affect the accuracy of the financial statements and often require correction because they violate accounting principles. Some errors do impact the trial balance, like compensating errors, where two mistakes offset each other. For example, understating expenses by 1,000 and overestimating revenue by the same amount. These errors do not affect the trial balance's balance, but distort the financial picture. It's also crucial to understand the difference between errors and fraud. Errors are unintentional mistakes, often due to oversight or misjudgment, while fraud involves deliberate manipulation to deceive or misappropriate assets. Recognizing this difference helps in maintaining integrity and accuracy in financial reporting. Now, what is a suspense account? It's a temporary account used to record discrepancies when the trial balance doesn't match. Once the errors are identified and corrected, the suspense account is cleared, ensuring the books are accurate. In summary, understanding these basics, like types of errors and their effects, helps us maintain accurate financial records and ensures our accounts reflect the true financial position of the business. Let's now delve into the basics of accounting, focusing on errors that can affect the trial balance and how we can correct them. First, it's important to understand that errors can occur at various stages of recording transactions, and these errors can lead to discrepancies in the trial balance. We need to identify these errors accurately and rectify them systematically. One key concept here is the role of the suspense account. When errors are identified but cannot be immediately corrected through journal entries, we use the suspense account as a temporary placeholder. It helps us keep the books balanced until we can locate and correct the errors properly. Now, let's look at some common errors and how to rectify them. For example, if the sales book is overcast by rupee 1,000, we need to make an adjusting journal entry to correct this overstatement. Similarly, if rupee 2,500 received from Mohan hasn't been posted to his account, we need to post that amount to his ledger account to rectify the omission. Another example is when machinery purchased for 10,000 is mistakenly posted to the purchases account. We need to transfer that amount from the purchases account to the machinery account. Also, if rent paid of 800 is incorrectly entered in the wages account, we need to correct this entry to reflect the proper accounts. To better understand these errors, we can prepare a table that shows different types of errors, their effect on the trial balance, and the appropriate method of rectification. This helps us systematically approach error correction. Moving on, let's clarify the concepts of one-sided and two-sided errors. One-sided errors occur when an error affects only one side of the trial balance, either the debit or credit side, without affecting the overall balance. Two-sided errors, on the other hand, affect both sides but may still leave the trial balance tallied incorrectly. Rectifying these errors involves specific journal entries that restore the accuracy of the books. Errors are often detected through trial balance discrepancies. For example, if the trial balance doesn't tally, it indicates that there's an error somewhere, maybe a misposting, omission, or principal error. Carefully analyzing the trial balance can help us pinpoint the specific mistake. Finally, I want to mention that there are various types of errors, and we can rectify at least 5 common ones through proper journal entries. Recognizing these errors and correcting them promptly is essential for accurate financial reporting. Now, moving to the multiple choice questions, it's important to understand the concepts behind omission errors, errors of principle, and compensating errors, among others, as they all have different implications for our accounting process. Let's go through some key concepts related to the basics of accounting and trial balance errors. First, when we talk about errors that affect the trial balance, it's important to understand that not every mistake will cause the trial balance to be out of sync. For example, omission errors, where a transaction is completely left out, typically don't affect the trial balance because the totals still match. Moving on, when we correct an error through a rectified entry, we post this in the journal proper. This is the correct place for adjustments and corrections. Now, errors in totaling, such as summing a column incorrectly, are considered clerical errors. These are mistakes in calculations or data entry that can be easily fixed once identified. Posting errors, which happen during the transfer of data from one ledger to another, are generally classified as clerical errors as well. But they can sometimes involve both clerical and principal errors if the fundamental accounting rules are violated. If a wrong account is debited, that's usually a principal error because it violates the basic accounting rule of debit and credit. Interestingly, the trial balance can still match even if there's a principal error, especially if the error is balanced elsewhere in the accounts. Now, consider the case where wages are debited to salaries. This is a principal error because wages and salaries are distinct accounts, and mixing them up violates correct accounting principles. Overcasting the sales book is a clerical error, often due to data entry mistakes. Errors of duplication, where a transaction is recorded twice, affect the trial balance because they cause incorrect totals. Similarly, recording the wrong amount in the correct account is a clerical error, usually due to miskeying. Omitting the double entry entirely is an omission error, which means part of the fundamental accounting process is missing. Debiting a nominal account instead of a real account is a principal error, since it violates the proper classification of accounts. Finally, if an error is detected after preparing the trial balance, it can often be rectified through a journal proper entry. This is the correct step to ensure the books are accurate. Throughout this discussion, remember that understanding these errors helps us maintain accurate financial records and ensures our trial balance truly reflects the company's financial position. Let's discuss some fundamental aspects of accounting errors and their correction. First, rectification of errors is typically done after the audit is complete, so the correct answer here is B, before final accounts. It's important to identify and correct errors before preparing the final statements to ensure accuracy. Next, consider errors that affect two accounts but do not impact the trial balance. These are known as two-sided errors, which means both accounts involved are affected, but the trial balance still balances. The correct term is a two-sided error. Recognizing these errors helps us understand that not all mistakes will immediately show up in the trial balance. Moving on, let's look at the use of suspense accounts. Suspense AC is used when the trial balance doesn't tally, meaning the totals don't match. This account acts as a temporary placeholder while we locate and correct errors. The suspense account is classified as a B real AC because it deals with tangible or real accounts involved in balancing. When we open a suspense account, it's primarily to rectify differences that arise from errors or omissions, so the correct answer is C, rectify differences. When errors of partial omission occur, they typically affect the trial balance, which is why these errors are quite significant. Correcting these errors involves adjusting the trial balance to ensure all figures tally correctly. Once errors are rectified, the suspense account is usually balanced and closed, meaning it no longer appears in the books. This process ensures that all discrepancies are resolved and the accounts reflect the true financial position. The suspense account appears in the trial balance as it helps us identify and temporarily hold discrepancies until they are corrected. So, the correct answer here is a trial balance. Finally, one-sided errors, which affect only one account, are generally corrected through journal proper entries. This method helps us adjust the books accurately without affecting other accounts unnecessarily. Understanding these concepts is crucial because they help maintain the integrity of our financial statements and ensure accurate reporting. Recognizing when and how to use suspense accounts and correct errors is a key skill in accounting. Let's start by looking at slide 112, which covers the basics of accounting related to the suspense account. First, we see that the suspense AC balance appears on the balance sheet when it is not closed. This typically happens when there's an unresolved discrepancy in the books that needs to be temporarily parked. Next, we consider which error requires a suspense AC. The key point here is that when there's a posting error, like posting to the wrong account, recording the wrong amount on one side, or omitting a transaction, the suspense AC helps us manage these issues until we can correct them. Moving on, if cash sales are not posted to the sales account, what happens? Well, in such cases, a suspense AC is needed because the trial balance may still tally, but the actual transaction hasn't been correctly recorded in the sales account. This highlights how suspense AC acts as a placeholder for unresolved posting issues. Now, when there's a difference in the trial balance, the typical entry is to debit the suspense AC. This helps us balance the books temporarily while we investigate and correct the errors. It's also important to understand that an error of principle, like applying an accounting principle incorrectly, affects the profit and the ledger, but does not usually affect the trial balance directly. The suspense account is generally opened in the trial balance to facilitate the correction process. It serves as a temporary account to hold discrepancies until they are resolved, making the process smoother. Next, errors that do not affect the trial balance, such as certain minor mistakes, don't impact the suspense AC directly. These errors may require correction, but don't cause a mismatch in totals. When errors are detected after the final accounts are prepared, the usual practice is to rectify them in the next accounting period, although sometimes they are adjusted in the current period's financials if material. Regarding the under- or overcasting of subsidiary books, such errors do affect the suspense AC because they cause discrepancies in the trial balance, prompting us to use the suspense AC to manage these errors temporarily. The suspense AC plays a vital role in preparing accurate financial statements by helping us identify and correct mispostings. It essentially acts as a tool for maintaining the integrity of the books during the correction process. Finally, if the difference in the trial balance is on the credit side, the suspense AC is credited, reflecting that the books are short on the debit side. This helps us keep the books balanced while we work on identifying the cause of the discrepancy. Overall, understanding how and when to use the suspense AC is crucial for maintaining accurate and reliable financial records. Let's talk about the basics of accounting related to the suspense account. When an error is detected in the books, the suspense account comes into play. Its purpose is to temporarily hold the difference until the error is located and corrected. Now, if we find an error, the suspense account is usually written off or balanced once the mistake is fixed. It's important to understand that the suspense account is open to keep the books balanced when there's uncertainty or an unresolved discrepancy. A key point to remember is that the suspense account is a temporary account. It can have both debit and credit balances, depending on the nature of the discrepancies. However, there are some limitations. For instance, over-reliance on a suspense account might mask underlying errors, and it's not a solution for permanently hiding mistakes. It's just a tool to manage discrepancies temporarily. So, how do we close a suspense account? Once the errors are identified and corrected, the suspense account is cleared by transferring the balances to the correct accounts, making sure the books are balanced. The main purpose of posting errors to a suspense account is to ensure the trial balance remains balanced, even when errors are present. This helps maintain the integrity of the books until the errors are resolved. Lastly, certain types of errors that affect the trial balance, like transposition errors or errors of omission, require the use of a suspense account. This is a crucial part of maintaining accurate financial records and ensuring the correctness of the trial balance. Let's delve into the basics of accounting, focusing on the use of suspense accounts for rectifying one-sided errors. When errors occur that affect only one side of the accounting equation, a suspense account can be a helpful tool to temporarily hold the discrepancy until it is corrected. This ensures that the trial balance remains balanced, even if the errors haven't been fully identified or corrected yet. Speaking of trial balances, a suspense account impacts it by balancing out these discrepancies. If the trial balance doesn't tally, a suspense account can be used to record the difference temporarily. Once the errors are pinpointed, we can make the appropriate adjustments to settle the suspense account, restoring balance to the trial balance. Now, let's consider how errors affecting the trial balance are rectified through the suspense account. For example, if a purchase of rupee 3000 from Raja was not posted, we can debit the purchase account and credit the suspense account. When the error is discovered, we can then transfer the amount from the suspense account to the correct account, ensuring everything is accurate. It's important to distinguish between a suspense account and a profit and loss account. The suspense account is a temporary holding place for errors or uncertainties until they are resolved, while the profit and loss account summarizes the income and expenses over a period, reflecting the company's profitability. So, what are the steps involved in identifying and rectifying errors using a suspense account? First, we identify the discrepancy in the trial balance. Next, we record the correction in the suspense account, adjusting the relevant ledger accounts. Finally, once the error is located, we transfer the amount from the suspense account to the correct account, and the trial balance is balanced again. Let's look at some practical journal entries. Suppose a discount allowed of rupee 500 was mistakenly posted to the discount received account. We would debit the discount allowed account and credit the suspense account. For a credit purchase from Roger of 3,000 that was not posted, we would debit the purchase account and credit the suspense account. When correcting, we reverse these entries appropriately. Now, what role does the suspense account play in preparing final accounts? It acts as a temporary placeholder for errors, ensuring that the accounts are balanced before finalization. Once all errors are corrected, the suspense account is cleared, and the final accounts accurately reflect the company's financial position. Lastly, let's touch on some errors that can be temporarily adjusted using a suspense account. These include errors like misposting an amount, posting to the wrong account, or errors discovered during the trial balance that haven't yet been fully traced. Moving to Part C questions, a suspense account is essentially a special account used temporarily to record discrepancies or uncertainties. For example, if the trial balance doesn't match, a suspense account helps us keep the books balanced while we investigate the cause. Situations requiring a suspense account often involve discrepancies in trial balances, errors in posting, or misclassifications. For instance, if cash received from Ramu of 2,500 was not posted, we would debit the cash account and credit the suspense account until the error is rectified. Errors are rectified using a suspense account both before and after preparing the trial balance. Before, it's used to temporarily balance the books. After, it helps in correcting the errors identified during the review process. Let's consider some specific errors. If cash received from Ramu of 2,500 was not posted, we debit cash and credit the suspense account. If furniture purchased for 5,000 was wrongly debited to purchases, we correct it by reviewing the entry and posting it to the furniture account. Overcast sales of 1,200 mean we subtract that amount from sales. And if rupee 4,000 paid to Mohan was debited to Sohan's account, we adjust by reviewing the incorrect entry and making the correct posting. Finally, understanding how errors are located through a trial balance and then rectified via a suspense account is crucial. The trial balance helps us identify discrepancies, and the suspense account allows us to temporarily hold the balancing amount while we investigate and correct the errors, ensuring our accounts are accurate and balanced. Thank you. Let's talk about the significance of the suspense account in financial accounting. Essentially, it acts as a temporary holding place for transactions when there's uncertainty or errors that need to be sorted out. For example, if we notice a discrepancy during reconciliation, we can record the amount in the suspense account until we identify the correct account or rectify the mistake. Now, comparing the suspense account with a rectification account, the main difference is that the suspense account is used temporarily to hold unresolved errors, while the rectification account is used to correct specific errors once identified. The suspense account helps us keep the books balanced in the meantime. Let's look at an example to prepare a suspense account from some errors. Suppose there's a sales overcast by rupee 2,000. That's recorded too high. Also, rent paid was rupee 1,500, but it was posted as 15,000, an overstatement. Lastly, a purchase of a machine worth rupee 10,000 was incorrectly posted to the purchases account. We would record these errors in the suspense account to keep our books balanced until we correct them. Using a suspense account has its pros and cons. On the plus side, it helps us maintain balanced books and avoid confusion when errors occur. On the downside, if not cleared promptly, it can lead to ongoing inaccuracies and potential misstatements in financial reports. Finally, to identify, post, and eliminate the suspense account once all errors are rectified, we first detect the errors through reconciliation or review. Then, we post adjustments to the suspense account, and once all corrections are made, we clear the suspense account by transferring the amounts to their proper accounts. This process ensures our books are accurate and reflect the true financial position. Now, let's understand the causes for differences between the cash book and the pass book. These differences can occur for several reasons. First, timing differences happen because transactions recorded in the cash book might not be reflected in the bank statement immediately, especially if they are recent deposits or withdrawals. Second, errors in recording can lead to discrepancies, mistakes made either in the cash book or the bank records. Third, sometimes checks issued by the business haven't yet been presented for payment, so the bank doesn't reflect them in the pass book. Similarly, deposits made but not yet credited by the bank can cause differences. Lastly, bank charges or interest entries that the business hasn't recorded yet can also create mismatches. Understanding these causes is crucial because they highlight why discrepancies happen and why preparing a bank reconciliation statement is so important. It helps us ensure our records are accurate, detect errors or potential frauds, confirm our actual bank balance, and manage cash more effectively. Now, let's look at some common reasons why there might be discrepancies between the bank column of the cash book and the bank statement. First, checks issued by the business but not yet presented for payment can cause a difference. This happens because the recipient hasn't yet gone to the bank to cash or deposit the check, so the cash book will show a lower balance, while the bank hasn't recorded the payment yet. Next, checks deposited but not yet cleared can also create discrepancies. These deposits might still be in the clearing process, so although the cash book shows a higher balance, the bank hasn't credited the account yet. Another common issue is bank charges that the business might not have recorded. Banks often deduct fees for services like processing or check returns, and if these aren't recorded in the cash book, the pass book balance will appear lower. Conversely, interest credited by the bank on deposits or balances can cause the pass book to show a higher balance if the business hasn't recorded this interest yet. Similarly, direct deposits made by customers into the business's bank account might not be known to the business immediately, leading to a higher pass book balance. On the other hand, direct payments by the bank, such as insurance premiums or loan EMIs, can reduce the bank balance without the business recording these transactions, causing discrepancies. Lastly, errors in the cash book, like mistakes in totaling, wrong entries, or duplicate entries, can also lead to differences. Recognizing these common causes helps us understand and reconcile the differences effectively. Let's explore the basics of accounting, specifically focusing on the format of a bank reconciliation statement, or BRS. Firstly, it's important to understand that there is no fixed format for preparing a BRS. You can start from the cash book balance and then make adjustments to arrive at the pass book balance, or you can do it the other way around. Start from the pass book balance and adjust to the cash book balance. Now, a standard format typically looks like this. We begin with the title, Bank Reconciliation Statement as on date. Then, we have a table with two main columns, particulars and amount in rupees. In the particulars column, we list the starting balance, either from the cash book or the pass book. For example, balance as per cash book or balance as per pass book. Then, we make adjustments. We add items like checks issued but not yet presented to the bank, or amounts directly deposited by customers, or interest credited by the bank that hasn't been recorded in the books. On the other side, we subtract items such as checks deposited but not yet cleared, bank charges not recorded in the cash book, or direct payments made by the bank. We also account for errors, either adding or subtracting, if there are discrepancies in the books. The goal of these adjustments is to arrive at the correct balance, which should match in both the cash book and pass book. Now, let's walk through the steps involved in preparing the BRS. First, you choose your starting point, either the cash book balance or the pass book balance. It's essential to note whether this starting balance is a favorable balance or an overdraft. Next, you add or subtract the differences. For example, you add items credited by the bank but not yet recorded in your books, such as interest or direct deposits. Conversely, you subtract items debited by the bank but not recorded in your books, like bank charges or bounced checks. Finally, you adjust for uncleared checks, unpresented checks, and any errors found during reconciliation. Once you've made these adjustments, you calculate the new balance. The objective is to ensure that the adjusted balances from both the cash book and pass book match, confirming that your records are accurate and up to date. This process is fundamental in maintaining proper accounting records and ensuring your bank statements and books are aligned. Now, let's look at the basics of accounting related to bank reconciliation statements. After making all necessary adjustments, the final figure we arrive at will be the reconciled balance, which matches the balance as per the other book. When preparing a bank reconciliation statement, there are two common scenarios to consider. First, starting with the cash book balance. In this case, adjustments include adding items that increase the pass book balance, such as interest earned or direct deposits made by the bank. Conversely, we subtract items that reduce the pass book balance, like bank charges or checks issued but not yet presented. The second scenario is starting with the pass book balance. Here, adjustments involve adding items that increase the cash book balance, such as checks deposited but not cleared yet. And we subtract items that decrease the cash book balance, like uncleared checks or outstanding payments. Let me walk you through an example to clarify these points. Suppose the balance as per the cash book is rupee 10,000, and this is a debit balance. We have checks issued but not yet presented totaling rupee 2,000 and checks deposited but not cleared amounting to 1,500. Additionally, bank charges of rupee 200 are not yet recorded, but the bank has credited interest of rupee 300. To prepare the bank reconciliation statement as of 31st March, we start with the cash book balance of 10,000. We then add the checks issued but not presented, which is rupee 2,000, and also add the bank interest credited of rupee 300. From this, we subtract the checks deposited but not cleared, which is rupee 1,500. This process helps us reconcile differences and arrive at an adjusted balance that accurately reflects the true position. Thanks to these adjustments, the bank statement and the books will match, ensuring our records are correct and up to date. Let's go through some basics of accounting related to bank reconciliation statements. As you can see on this table, we start with the balance as per pass book, which is rupee 10,600. We then subtract bank charges that haven't been entered yet, which amount to 200. This adjustment helps us arrive at the correct balance. Now, moving on to the advantages of preparing a bank reconciliation statement, or BRS. First, it helps us detect errors in both the cash book and the bank statement, ensuring our records are accurate. It also plays a vital role in accurate financial reporting, preventing frauds or unauthorized transactions, and enabling better fund management. Additionally, BRS acts as a control measure for internal audits, giving us confidence in our financial data. However, there are limitations to keep in mind. For instance, BRS doesn't prevent errors, it only helps us identify them. Preparing it on time is crucial because delays can reduce its usefulness. Also, BRS doesn't account for future-dated transactions, and if we're not using automation tools, it requires manual effort. Speaking of automation, Today's accounting software like Tally, QuickBooks, and Zoho Books can automate the bank reconciliation process. These tools import bank feeds, automatically match entries, and generate alerts for unmatched transactions. This automation saves a lot of time and enhances accuracy, especially in larger organizations. Now, let's look at an example to illustrate this. Suppose the balance as per the cash book is $10,000. There's a check of $2,000 issued but not yet presented to the bank, and another check of $1,500 deposited but not yet cleared. In preparing the bank reconciliation statement as of 31st March, we would account for these timing differences to arrive at the correct bank balance. Let's take a closer look at some basic aspects of accounting through these examples. First, we have the reconciliation between the cash book and the passbook. The initial balance as per the cash book is $10,000. We then add the check issued but not yet presented for payment, which is rupee 2,000. This increases our balance. Next, we subtract the check deposited but not yet cleared, amounting to $1,500. After these adjustments, the balance as per the passbook comes to rupee 10,500. This illustrates how timing differences can affect our bank balances. Moving on, in illustration 52, we see how bank charges and interest impact our accounts. The balance as per the cash book is $15,000, but the bank charges of rupee 300 haven't been recorded in our books yet. Meanwhile, the bank credited us with rupee 500 in interest. To prepare the bank reconciliation statement as of 31st March, we add the interest to our cash book balance and subtract the bank charges, resulting in a corrected balance of $15,200 as per the passbook. Finally, in illustration 53, we examine the case of a direct deposit made by a customer. Our cash book shows a balance of rupee 8,000, but the customer deposited an additional rupee 2,000 directly into the bank, which hasn't been recorded in our cash book yet. When reconciling as of 30th June, we need to add this amount to our books to match the bank statement. Overall, these examples highlight the importance of reconciling our cash book with the passbook regularly. Differences due to timing, bank charges, interest, or direct deposits are common, and understanding how to adjust for these ensures our financial records are accurate and reliable. Let's look at some basic concepts of accounting with these illustrations. First, consider the cash book and passbook balances. The cash book shows a balance of 8,000 rupees, but after adding the deposit made by the customer, which is 2,000 rupees, the passbook balance comes to 10,000 rupees. This highlights how timing differences or omissions can create discrepancies between these two records. Now, moving to illustration 54, where we have a standing instruction payment. The passbook shows a balance of 12,000 rupees, but there's an insurance premium of 1,200 rupees debited by the bank that hasn't been recorded in our cash book. To reconcile this, we prepare a bank reconciliation statement. Starting with the passbook balance of 12,000, we subtract the insurance paid by the bank, which is 1,200 rupees, giving us a corrected cash book balance of 10,800 rupees. This process helps us identify and adjust for transactions recorded by the bank, but not yet reflected in our books. Similarly, in illustration 55, we see a check dishonored. The passbook balance is 9,500 rupees, but since a check of 1,000 rupees deposited was dishonored and not recorded in our cash book, we need to make adjustments. To reconcile, we start with the passbook balance of 9,500, subtract the dishonored check of 1,000 rupees, which results in a cash book balance of 8,500 rupees. These examples underscore the importance of bank reconciliation, ensuring our records are accurate and balanced. Adjustments like these help us spot errors, omissions, or timing differences, which are crucial for maintaining accurate financial statements and overall financial health. Let's look at some common situations that require bank reconciliation. Starting with illustration 56, we have an overdraft balance according to the cash book of rupee 5,000. However, there are a few adjustments to consider. First, there's a check issued for 2,000 that hasn't been presented to the bank yet, so it's not reflected in the passbook. Second, bank charges of rupee 300 haven't been recorded in the cash book. To find the actual overdraft, as per the passbook, we add the unpresented check of 2,000 and subtract the bank charges of rupee 300 from the cash book overdraft. This results in an overdraft of 3,300 as per the passbook. Next, in illustration 57, we have a balance of 7,000 in the cash book, but there's an error. A receipt of rupee 500 was entered twice. This overstatement needs correction. To reconcile, we subtract the excess entry of rupee 500 from the cash book balance, giving us a corrected balance of rupee 6,500, which matches the passbook. Finally, in illustration 58, we see a balance of 11,000 in the passbook. Although the slide doesn't specify the error here, this highlights that discrepancies can also originate from the passbook side, not just the cash book. The key takeaway is that bank reconciliation involves identifying these differences, whether from unrecorded bank charges, unpresented checks, or entry errors, and adjusting the records accordingly. This process ensures that both the cash book and passbook reflect the true financial position. Let's look at a common mistake that can happen with bank transactions. In this case, the bank wrongly credited rupee 1,000 twice. To correct this, we prepare a bank reconciliation statement as of 31st August. As you see, the balance as per the passbook was 11,000. We then subtract the duplicate rupee 1,000 credit, which brings the adjusted balance to 10,000. This process helps us identify and correct errors to match our records. Now, moving to a more complex example with multiple adjustments, we start with a balance of 20,000 as per the cash book. Several items need to be considered here. First, there's a check issued for 5,000 that hasn't been presented to the bank yet, so we add this amount. Then, a check deposited for 4,000 hasn't cleared, so we subtract that. The bank credited rupee 500 as interest, which we add to our balance. Conversely, bank charges of rupee 250 haven't been recorded in our books, so we subtract that. After adjusting for all these items, the final balance as per the passbook comes to rupee 21,250. These examples highlight the importance of reconciling our cash records with the bank statements regularly. It ensures that our books are accurate and helps us catch errors or omissions promptly. Now, let's look at how a bank reconciliation process works with a practical example. On this slide, we see an illustration where we start with a passbook balance of 25,000. There are a few transactions that we need to consider. First, a check issued for 3,000 hasn't been presented to the bank yet, so it hasn't been deducted from the bank's records. Then, there's a check deposited for 2,000 that the bank hasn't credited to the account yet. Additionally, the bank has made a direct payment of 1,000 that hasn't been recorded in the cash book. To reconcile these differences, we prepare a bank reconciliation statement as of 31st October. We start with the passbook balance, then add the check issued but not presented, and subtract the check deposited but not yet credited, along with the direct payment by the bank. After making these adjustments, we find that the balance as per the cash book also stands at rupee 25,000. This process highlights the importance of maintaining accurate records and regularly reconciling bank statements. A bank reconciliation statement is crucial because it helps ensure that the balances in our books match the bank's records. It helps us identify errors, prevent fraud, and improve financial accuracy. Regular reconciliation is a good practice for every business owner or accountant because it promotes transparency and trust. It keeps our financial data reliable and helps us manage our finances more effectively. Now, moving on to some back questions. First, what exactly is a bank reconciliation statement? It's a document that helps compare the bank's records with our own to identify discrepancies. Second, why do we prepare a BRS? To ensure our records are accurate, to catch errors early, and to prevent fraud. Third, what are some reasons for differences between the cash book and passbook balances? These could include outstanding checks or deposits not yet processed by the bank. Fourth, what do we mean by checks issued but not presented? It refers to checks we've written and issued but haven't yet been presented to the bank for payment. And finally, Checks deposited but not cleared are those we've deposited into the bank, but the bank hasn't yet processed or credited them to our account. Let's explore some key points about the basics of accounting. First, consider transactions that appear in the bank statement but not in the cash book. For example, bank charges or direct deposits made by the bank often show up in the bank statement but are not recorded in the cash book initially. Recognizing these differences helps us keep our records accurate. Next, let's discuss the advantages of preparing a bank reconciliation statement, or BRS. It helps identify discrepancies, ensures our cash records align with bank records, and detects errors or fraudulent activities early. This process enhances our financial control and accuracy. Now, what do we mean by a favorable balance? It's when the bank balance shows a surplus, meaning we have more funds than recorded, which is a positive sign. Conversely, an overdraft balance occurs when we owe money to the bank, indicating a negative balance, often shown as a liability. A passbook is simply the bank's record of our transactions, updated regularly and provided to us by the bank. It's important because it helps us compare our cash book with the bank's records. Timing differences in BRS are caused by items like checks issued, but not yet presented, or deposited, but not yet cleared by the bank. These delays cause temporary mismatches between our records and the bank statement. Moving on to the detailed questions. Differences between the cash book and pass book often arise due to causes such as bank charges not recorded in the cash book, checks deposited but not cleared, or errors in recording transactions. When preparing a bank reconciliation statement, we start with either the cash book or pass book balance, then adjust for outstanding checks, deposits in transit, bank charges, interest, and errors. This step-by-step process helps us reconcile the two records. The importance of BRS cannot be overstated. It helps us maintain accurate financial records, detect errors or fraud, and ensures our cash position is correctly reflected in our accounts. For example, if the cash book shows rupee 10,000, but there are checks issued worth rupee 2,000 that haven't been presented yet, and deposits of 1,500 that haven't cleared, we adjust accordingly to find the true bank balance. An overdraft occurs when our bank account balance goes below zero. In the BRS, it's shown as a liability and indicates we owe money to the bank, which is crucial for understanding our financial position. Distinguishing between a passbook and a cash book, the passbook is the bank's record, while the cash book is our record of cash transactions. Both are essential, but they serve different purposes. Common errors causing mismatches include recording the wrong amount, forgetting to record bank charges, or timing differences like unpresented checks or deposits in transit. Favorable balance means our cash book or passbook shows a surplus, while an overdraft indicates we owe money to the bank. Understanding these helps us interpret our financial health correctly. Finally, when preparing a BRS with data like a 15,000 balance as per pass book, bank charges of 300, uncleared checks of rupee 2,000, and interest credited of rupee 500, we make adjustments accordingly. The format of a BRS includes the title, the balances, adjustments, and the final reconciled balance, each item explained briefly to give a clear picture of our bank position. Moving to the last part, a bank reconciliation statement is a document that helps us compare and reconcile our cash book and bank statement. It is essential because discrepancies can occur due to timing differences, errors, or omissions. Preparing it involves systematic adjustments to align both records, ensuring our financial data is accurate and trustworthy. This process is vital for maintaining good financial management and helps prevent fraud or errors from going unnoticed. The format typically includes the title, the opening balances, adjustments for outstanding items, bank charges, interest, errors, and the final reconciled balance, providing a complete view of our cash position. Let's discuss the causes of disagreement between the balance as per the cash book and the pass book. Differences often arise due to timing differences, errors, or omissions. For example, checks issued but not yet presented, or checks deposited but not yet cleared, can cause discrepancies. Now moving on to preparing a bank reconciliation statement, or BRS, as of 31st March, using the details provided. We start with the balance as per the cash book, which is Rupee 12,000. We need to account for checks issued but not presented, amounting to 3,000, and checks deposited but not cleared, which is Rupee 1,500. Additionally, we add bank interest credited of Rupee 800, but subtract bank charges not recorded of 200. We also include direct deposits by customers of 1,000. This process reveals various errors and omissions, such as timing differences, unrecorded bank charges, or interest. These are classified as errors of omission, commission, or principal, and they help us understand where discrepancies originate. When comparing the treatment of a favorable balance and an overdraft in BRS preparation, a favorable balance indicates the bank owes us money, and we treat it accordingly, usually showing it as a positive balance. In contrast, an overdraft is a negative balance, reflecting that we owe the bank money and is shown as a liability. The significance of preparing a BRS in business and accounting cannot be overstated. It helps verify the accuracy of records, detect errors or frauds, and ensures that both the cash book and bank statement are aligned. This process maintains financial integrity and provides clarity on cash position. BRS is especially useful in detecting errors or fraudulent activities, such as unauthorized withdrawals, unrecorded deposits, or incorrect entries, by cross-verifying transactions between the bank and cash records. Now, let's consider preparing a BRS from the overdraft scenario. Starting with the overdraft as per passbook of Rupee 5,000, we account for checks not presented, bank charges, interest, and customer deposits that haven't been entered in the cash book. This helps us reconcile the actual position and understand the reasons for the overdraft. Finally, I'll outline the steps for reconciling cash book and bank statement balances. First, compare the balances. Next, identify timing differences like checks issued but not cleared. Then, adjust for errors, unrecorded transactions, or bank charges. For example, if the cash book shows a higher balance, we add deposits not yet recorded by the bank or deduct outstanding checks. When preparing a BRS when the balance as per the cash book is given, we start with that balance, then add or subtract the relevant items like checks issued but not presented, deposits not credited, bank charges, or interest. I'll show you a specimen format, simple and clear, so you can follow the steps easily and ensure your reconciliation is accurate. Let's go through some key points from slide 122. First, the basics of accounting often involve understanding the bank reconciliation statement, or BRS. It's prepared mainly to reconcile the cash book and the pass book. This ensures that the records match and any discrepancies are identified. Question 1 highlights that BRS helps to reconcile the cash book and pass book, which is essential in verifying the accuracy of both records. Moving on, when a check is issued but not yet presented, it increases the pass book balance as the bank records this transaction, but it hasn't affected the cash book yet, so it's important to understand these timing differences. Next, bank charges recorded in the pass book but not yet in the cash book should be deducted from the cash book to match the bank statement. This is a common adjustment during reconciliation. When a check bounces or is dishonored, it reduces the cash or pass book balance, depending on how the dishonor is recorded. Another important point is direct deposits made by customers into the bank account. These are added to the cash book, but may not be reflected immediately in the pass book, so adjustments are necessary during reconciliation. Similarly, interest credited by the bank increases the bank balance, but might not be recorded in the cash book yet. When a check deposited but not yet cleared, we add it to the pass book in the reconciliation process, since the bank has received the deposit, but the cash book hasn't recorded it yet. The main purpose of BRS is to help match the bank statement with the company's cash book records, ensuring both are aligned. So, it helps confirm the accuracy of the balances and catch errors or discrepancies. A credit balance in the pass book indicates an overdraft, meaning the bank owes money to the account holder. Conversely, a debit balance in the cash book also suggests an overdraft situation. If a check dishonors, it reduces the cash or pass book balance, depending on where the record is kept. Bank errors are identified during the reconciliation process, often in the BRS, as discrepancies in the bank's record. Typically, the BRS is prepared by the accountant or the person responsible for maintaining the accounts, not by the bank or owner directly. Lastly, if an overdraft appears in the cash book, it is usually taken as a starting point in the BRS to adjust and reconcile the figures accordingly. By understanding these key points, we ensure the accuracy and integrity of our financial records, which is fundamental in accounting. Let's now look at some key concepts related to the basics of accounting, focusing on bank and cash book reconciliations. Starting with question 15, when the bank debits interest, it is actually credited in the bank statement, but in our books, it is added to the cash book. So, the correct approach is that interest credited by the bank is added to our cash book, reflecting the increase in our bank balance. Moving on to question 16, an unpresented check is one that has been issued but has not yet been cleared by the bank. It's not cleared yet, meaning the amount is still deducted from our books, but hasn't been reflected in the bank statement. Question 17 highlights that if an entry is missed in the cash book, it causes discrepancies. Specifically, it results in a difference in the bank reconciliation statement, or BRS. Missing entries can lead to mismatches that need to be identified and corrected. Next, question 18 points out what the BRS does not include. It typically excludes petty cash, bank charges, direct deposits, or dishonors. Among these, petty cash is separate from bank accounts, so it isn't part of the BRS. Question 19 emphasizes that the BRS helps ensure that the trial balance tallies, the bank statement matches, and the cash book and bank balance are aligned. Essentially, the BRS is a tool to confirm all these elements are consistent. Finally, question 20 discusses the time lag between bank and book entries. This lag can cause differences in balances because the bank and our books may record transactions at different times, leading to discrepancies that need reconciling. By understanding these points, we strengthen our grasp of how to maintain accurate financial records and ensure our bank reconciliations are correct.